Okay. Good morning, everyone, and good to see you all back again. So, now, uh, in the interest of time, I'll directly get into the subject. Uh, Today, this class is a marathon one. So, therefore, we may not be able to discuss every concept in detail because you know that this subject is something what we have discussed for months together. But now we will be wrapping it up between today and tomorrow. So the whole idea is just to refresh you from what you have learnt and retouch the points that we have discussed and to see that between today and tomorrow, the syllabus we are covering will be at least till 90% of your syllabus. That is the target of it. But at any time, you feel that little more explanation is required and all that, you can pass me on and either I will try to cover it now or I will try to cover it after the class. Coming to this is what I've shared it with you earlier and I'm sharing it one more time. This is the weightage. Because before we start our marathon, we need to have a clarity on and we need to refresh on what are the important chapters and how do we prioritize, because in any subject covering all the subjects and all the chapters is impossible and no student would be able to do that. So everybody goes for priority. So while going for priority, are we onto the right track? Is our selection the proper? So that is where let's have a relook at what is this subject and what is the weightage and what are we going to cover today and what we will be covering tomorrow. Now in this corporate and other laws, which is a 100 marks paper, this is the weightage that we have already taken a note of it, but this weightage is as per ICAI. So this is subject to 5 to 10% variation, but more or less this will be the weightage. In this, the topmost, the weightage is for this item number 5. That is, these 4 chapters, 8, 9, 10, 11, itself is about your 25 marks. That is 1/4 of it. Declaration of dividend, accounts of companies, audit and auditors, and companies incorporated outside India. So 8, 9, 10, 11 itself would get you 25 marks. And then the last one, and acceptance of deposit, 3 chapters, very simple chapters. 5 and 6 are very, very small, and even for you to refresh from the examination perspective, they are very limited in the content. And management is, of course, management and administration, it's a quite lengthy one, but the first 2 are the very simple ones. So I would recommend the 7th one, then the 6th one in order of priority, and where you get roughly around 21 marks. So, and then comes this 1, 2, 3, 4, which are the basic chapters that in any case you will be comfortable. The only thing that we need to refresh here is this prospectus. So it is better to just touch one more time because that is also like registration of charges, small chapter and good weightage and recurring questions. So in our priority while choosing it, let's not keep only the tough chapters in mind and we should be smart. So the choice of selection should be which are easy to kill and where we can score more marks. So since you are very close to the exam, let's hit that smart chapters first. So where you can easily brush up yourself and say, yes, I am done with that. And those chapters that you are covering should be good enough. Like for example, incorporation and preliminaries. Now 1 and 2, they are easy, but they're not been questioned too much of it. So there is no point in revising those small stuff. But the important chapters, the small chapters like registration of charges, prospectus, declaration of dividend, they're very less in quantum, but very important in terms of exams. So as a smart student, let's try to focus on those chapters which will give you more number of marks in a short period of time. So it is almost like our E category type. So keeping that in mind, let's start with this. Today we'll focus on Companies Act and tomorrow we'll focus on general laws like FEMA and all that, because that is little, among all these chapters, as you are aware, FEMA is the one which you need to really focus on. So I'm pushing it to tomorrow so that we will discuss as much as possible to refresh you on that. But the remaining ones, we will try to cover it up, the important concepts of it. So now, let's, having opened this, let's complete this registration of charges. Kindly open your material so that you are on pace with me. registration of charge. It is hardly 11 sections, 77 to 87. But as we have discussed, this is like your it comes in your priority one, whether you call it 3-star or EA or whatever it is. It's an important chapter, small chapter. But the only thing why I choose to pick this up is, apart from what you study in what is being given, there are certain additional points that we need to take a note of it out of this chapter. So let's try to refresh. In our regular classes, we have covered all of them, but let's try to revise it. Now, let's go directly to the definition of charge. What is charge? It is nothing but creating interest or lien on any property of the company or any of its undertakings. But why are we creating this charge? Why this interest is being passed on to someone else? For security for repayment of loan. Now, since we have already listened, just as a matter of brushing it up, there are three types of securities, modes of security. There are three types: hypothecation, mortgage, and pledge. Now, the difference, the essential difference of it is, we are aware. In hypothecation and mortgage, the asset that is given as a security will be in the custody of the borrower. Whereas in the pledge, which we call it as a pawn and all, pawn brokers in all of them in a common slang, that pledge, the custody of the security will be with the lender. Now, why we are discussing on this topic now is, the whole essence of this registration of charges is providing the security to the creditor. So now, keeping that point in mind, now you are aware for which mode of security this concept is available, this chapter is available, and for which mode of security this chapter is not applicable. So this chapter is applicable for two modes of securities. One is a hypothecation and mortgage. Because the custody of the security is with the borrower, there is a need to protect him, to see that the borrower is not damaging the security or he is not creating any other security. So therefore, it is applicable for these two, and for pledge, it is not applicable. That is what we learn it here. It includes mortgage. Now, here, since it is a revision, I take little bit liberty in asking you. From looking at exam questions, which we will see it, what is important out of what you are seeing on the screen is the definition of charge. So very rarely, but he is asking, what do you mean by a charge? And then the question follows, the difference between floating charge or fixed charge, or how do we create the charge, who has to register. So whenever we use the word charge, now you tell me, how do I define the charge? How do I define the charge? We discussed the keywords are, it is about creating an interest or lien. In whose favor? Who is creating and in whose favor? Is it the borrower creating in favor of creditor, or the creditor creating it in favor of the borrower? The borrower is creating this in favor of the creditor. Now the creditor, just let me see how much you remember. There is alternate technical name for creditor in this chapter. The alternate technical name for the creditor is charge holder. So there are two terms, charge giver and charge holder. So charge holder is the creditor and charge giver is this debtor. So that is the borrower. So whenever you have to define this word charge, it is all about creating interest or lien on the property of the company. So, or any of its undertaking, any of its subsidiaries, branches, anything of the company. But the creating charge must be for the security. Then it becomes a charge. And it includes mortgage. Now, as a quick repetition, what are the three modes of charge? Quickly. Hypothecation, mortgage, and pledge. Now, for which model this registration of charge is not applicable? For pledge. And the logic is simple, because the creditor is already secured, because he himself is having the security. So this is one probable MCQ that you may get it. Then let's move on. Who has to create the charge? Now there are two people. One is the borrower. In our case, the borrower is always the company, because we are discussing on this Companies Act. The company creating the charge. So now when the company is borrowing and the interest is created in favor of creditor to protect his interest, there the question comes, who has to register the charge? It is always the duty of the company to create the charge. So that is where it results into logical conclusion. The benefit is to the creditor, but the onus of creating the charge is on the company. So that is where we have discussed it in detail. But here, considering this marathon one, I will sum it up. Who has to create the charge? It is the duty of the company to create the charge. Now, on what assets they have to create the charge, and when the need for charging would arise. It's simple. As long as, like how in income tax you learn, once you are a resident, your global income is taxable. Here, once you are an Indian company, wherever you create the charge, that is, you are borrowing in India or you are borrowing outside India, this registration of charge becomes an obligation for the becomes an obligation of the company. Then we have, which assets do I need to create this charge? Is it only for tangible or intangible? It includes all types of factors. So to sum it up, because these are the points where it looks simple, but even in your material, you can take a star to this as well. That is, this registration of charge would require not only for tangible assets, but also for intangible assets. Then, how do we create the charge? When the company has to create, what are the documents they submitted for creating the charge? And with whom do we create the charge? Now you tell me. Now, whenever I'm creating the charge, or I go one step backwards, when I'm talking about charge, there are two words that are important. One is creation of charge, and second one is registration of charge. Now, which comes first? Creation of charge. And creation of charge happens between? Who are the parties involved in creation of charge? Borrower, and that is the company, and creditor. Creditor also, we also call him charge holder. So that slowly you become familiar with that. So it is the relationship between the company and the charge holder. And registration of charge. Who are all the parties involved? Company, charge holder, and one more, ROC. Now, what documents will have to be filed by the company for creating the charge? There are two, CHG1 or CHG9. If it is for debentures, then it is CHG9. If it is for other than debentures, it is CHG1. One probable MCQ. So here. So now, since we have already covered this, I'll just go to the diagram so that, see, this is what is an pictorial representation of this entire discussion. When the company is borrowing the money and giving any building as a security, first they enter into the loan agreement. The entering into loan agreement is what we call it as, what is that stage called? Creation of charge. And once you create the charge, then who will have to go and register the charge? Company will have to go and register the charge. With whom will they register? ROC. And what forms do they file? CHG1 or CHG9. And which one is relating to debentures? CHG9 is relating to debentures. So, whereas CHG1 is for other than debentures. Now, once you file these forms along with the loan agreement, then ROC is going to give this registration of charge certificate to both. That is the borrower and this lender. That form number is CHG2. So, as a quick revision, there are three forms that we have discussed. Now, quickly revise. What are the three forms? CHG1, CHG9, and CHG2. Now, CHG1 and 9, who is filing with whom? Company is filing with the ROC. And this, which is the CHG2, who is issuing to whom? ROC is issuing to the company and the borrower. He will issue to the both of them. Now, let me see how much you remember. What are the timelines for creating the charge? There are three timelines. First one is 30 days, 60 days, and 90 days. Now, let us have a look at it. And what are all the three types of fees that we have? Normal fee, additional fee, and ad valorem fee. Now, let us look at this chart first. Now, this is an amended one, and these charges are effective after this 2/11/2018. So, the first time limit for registering the charge is 30 days. My 30 days starts from My 30 days starts from date of creation. So my 30 days starts from date of creation. So up till 30 days, what I will pay is the normal fee. But if I fail in this 30 days, then my next slot is next 60 days. But that 60 days, is it next 60 days or 60 days from creation? 60 days from creation. So that is like 30 plus 30. So what are the fees that I'm going to pay? Normal fee plus additional fee. Now if I fail in both, then what happens? Then what is the timeline given? Then we get into the third one, 60 days. But my 60 days here, is it from date of creation or next 60 days? Next 60 days. That is how we get into this 120 days. Ad valorem fee, normal fee, additional fee and ad valorem fee. So just to make you quickly familiar, now you tell me, what are the three timelines that I have? 30 days, 60 days and 120 days. Now what are the three fees I am having? Normal fee, additional fee and ad valorem fee. Now normal fee is effective between what days? 0 to 30. And additional fee would come into effect from 31 to 60. And ad valorem would come into picture from 61 to 120. So this is what is this picture of it. Now, what happens if the company fails to create the charge? Company is supposed to do it. It is the obligation of the company. But if the company is not creating that charge, then what happens? Charge holder can create. But whenever the charge holder is creating, then that is covered under section 78. Whenever the charge holder is wanted to create, then ROC will not straight away register. ROC will issue a show cause notice. Who will issue the show cause notice? ROC will issue, and ROC will issue the show cause notice to whom? To the company. So, and what is the timeline given for the company to respond? 14 days. So, looking at this diagram of it, whenever there is, first comes this charge creation. And after the charge creation, ideally it is the duty of the company to go and file CHG1 or CHG9 with the ROC. But if that is not happening, but he may not do it because he has nothing to lose. That is when the charge holder himself may want it to protect. So in which case, the charge holder will go and file CHG1 or CHG9 with ROC, and then the ROC will not straight away do it. So that is when he is issuing show cause notice. So as a simple clarity, who is issuing show cause notice to whom? ROC is issuing to the borrower. And what is the time limit given for the company to respond? 14 days. So they can refuse or they can admit. Now, if no response is received, then ROC will go ahead straight away and register the charge and issue one certificate called CHG2. So this is what is the obligation. Now you tell me, whenever charge holder is registering, the ROC is, the point is simple. Whether company is registering or charge holder is registering, without money he will not register. So there are charges to be paid at the time of registration. Normally, company would have to pay. Company would have taken that charge. But if charge holder is creating this, then will they get the right to get reimbursement from the borrower? The answer is yes, because he is asking questions on that. So even though the charge holder is registering, but the whatever is the cost that is involved will be collected from the company. They are entitled to collect this money from the company. That is what we have taken. Then, what is the date of notice? That is from when the charge would come into the picture. Now, the charge would come into the picture from the date of registration. So, the date when you are registering, that is from that date, that is when the charge would come into the picture. Now, I will stop for a while. I will just go back, make you familiar with, this is the general content. But what are the additional points that we need to discuss here? We will just cover it till here and then we'll move forward. Now you tell me, when I'm talking about this charge, there are two technical words that we have to talk about. Creation of charge, registration of charge. Now I want you to answer fast, because since you have come all the way, by this minute, every minute of yours, I know the importance. And when you have come all the way, you should go back with some kind of satisfaction that you are able to revise completely. And at least the chapters that we are covering, you need not again look at it. So, but it requires you to participate more. The more you participate, the more it's going to help you. Now let's come back. Otherwise, what will happen? Again, you listen one more time and listen and going, and it will become effective wastage of this many hours, which is not the intention. So kindly participate. And it will give you good amount of confidence. Now I'll go back. When I repeat the same question, when I am using the word charge, there are two technical words in it: creation of charge, registration of charge. Which comes first? Creation of charge. Now, who are all the parties involved in creation of charge? Company and the borrower, the lender. And the registration of charge, with whom do I register? ROC. Now, who will have to register? Company will have to register. What are the three timelines within which I have to register? 30 days, 60 days, and 120 days. What are the three fees? Normal fee, additional fee, and ad valorem. Now, quickly, when do I have to pay ad valorem? What day to what day? 61 to 120. When I will have to pay additional fees? 31 to 60. Now, what happens when the company is not registering? Charge holder can go and register. Whoever is registering, they have to file two documents: CHG1 or CHG9. Which one is relating to debentures? CHG9 is for debentures and CHG1 is for other than debentures. Now, once these forms are filed, ROC will issue certificate of registration of charge. That form number? CHG2. So, CHG2 is issued by the ROC to both the parties, and CHG1 or 9 is filed either by the company or the charge holder to it. Now, being an Indian company, whenever you are registering, what assets will they register? What assets there is a mandatory obligation to register? Is it for tangible or intangible? Both. So whether it is a tangible asset or intangible asset, you will have to do that. And then as a quickly, we do see this exam questions, but as a quick revision, an Indian company borrowing in US from a US bank, do I have to register in India? I repeat, because these are the concept related questions. The reason for selecting this chapter is also that itself. You do get questions, lot of questions, and almost all the questions which are slightly above what the text that is included in your material. So little bit of depth is required. Now, let's say X Limited. I say X Limited. This is an Indian company. Let's say their head office is in Delhi. Now, they have taken a loan in US from a bank in US. So indirectly, it is an Indian company, but they have not taken any loan in India. They have taken a loan in US. Now, the question comes, do they have to register this charge in India? Because till the time you get into those things and these kind of discussion, simply repeating what is being discussed is of no use, because these are the advanced questions that are being asked. Now, I'll simplify this for you. Remember it in a simple way. Once you are an Indian company, wherever you create the charge, meaning whether you take the loan in India or you take loan abroad, and which assets are you giving, whether Indian assets or foreign asset, it doesn't matter. Like that's why you always remember in a simple way, like how once you are an Indian citizen, your global income is taxable in India. Similarly, once you are an Indian company, wherever the loan is taken, whichever the assets that are given for security, there is a need for you to come and register with the ROC. So even in this case, this company will have to come and finish their formalities of registration with the ROC in India. But once you are a foreign company, then do they have to come and register? That's not covered in this. In this entire chapter 77 to 87, we will be talking about, because since this is a Companies Act, and Companies Act, we talk about this Indian companies. And what is its relevance to the foreign companies, that we'll cover it in that other chapter. Now, coming back to it. There are two sections which are, which needs to be remembered. One is section 77 and another one is section 78. 77 talks about registration by the company and 78 talks about registration by the charge holder. So these are the two different sections. Now, again, I want you to repeat it, because this chapter I will go too much in detail, because as I keep alerting you, very important chapter, not in the last attempt. Of course, ICAI will keep playing jig-jag. Last attempt, that is January 26, he didn't ask much. He did ask, but not much. But in the earlier attempts, there were attempts where even suddenly 10 to 15 marks will come out of it. And whenever it comes, the majority of the questions are beyond what is covered in the material. So therefore, this chapter, let's have all the patience and study it in detail. So though it is a marathon, but since the chapter is small, discussing even in depth will not take more than 1.5 hours. So let's cover it. Again, I go back and I ask you the same questions till the time I feel that you all are comfortable. Now, one word to define charge. Creation of interest or lien. Now, there are two technical words in with relating to charge. Creation of charge, registration of charge. Which comes first? Creation of charge. And who will have to register the charge? Company. And under what section? 77. But if the company fails, charge holder will register. What section? 78. So, as a rapid question, under 77, who will have to do the registration? Company. And charge holder is registering, then what section would come into picture? 78. Now, slightly a different one. Under which section the show cause notice would come into the picture? 78. Because under 77, that is when the company is registering, there is no need for show cause notice. But when the charge holder is registering, show cause notice would arise. Who is issuing the show cause notice to whom? ROC is issuing the show cause notice to the company. And what is the length of the show cause notice? 14 days. That is also a small probable MCQ. So this is what is the pictorial diagram in such case. So if the charge holder is registering, ROC would issue a show cause notice to the company, and basis the response by the borrower, the ROC will go ahead and register the charge, which is CSG2, which he will issue to both the parties. Now, before I go to that date and the other types of it, let's complete this small topic, because even in the latest question, he had asked for the differences of it. Now, what are the two types of charges? Fixed charges and the floating charges. Now, which one is more safe for the banker? So for that, you need to know the difference between what is fixed charge and what is floating charge. First, let us cover this first, and then we will look at the details of it. Now, when you say fixed charge is always created on identifiable property, like land, buildings, machinery, basically assets, fixed assets. And floating charge is always created not an individually identifiable asset, but class of assets like stock. So, stock, debtors. Now, these stock and all will not be like a building. It is individually identifiable. But when it's a raw material, you're not handpicking any one item in it. They are better recognized as a group of assets. So, that is what we call it as a class of assets. Floating charge is always created on class of assets. Fixed charge is always created on identifiable assets. And example of it, all the fixed assets would come under fixed charge, like land, buildings, machinery. And floating charge, assets like data, stock and all would come into it. And the bigger difference between them is, the company cannot deal in such asset if it is a fixed charge. That is, without the permission of the charge holder, they cannot destroy and they cannot sell. But if it is a floating charge, the company is at free will. So they can deal with that asset. They can modify that asset. They can even sell that asset. So that is where, as a banker, I always wanted this fixed charge. So that once a security is given to me, that will not be damaged. That will not be transferred without my knowledge. So a fixed charge is more safer for the banker. But now, can I convert, since you already listened to this, I'm taking liberty in asking. There is a concept under which one charge is converted into the another one. Crystallization. Under crystallization, which is converted to what? Floating is converted to fixed, or fixed is converted to floating? Floating is converted to fixed one. So that can happen whenever the creditor feels little threatened about the possibility of recovery. That is where a question can come as a short answer question. What are all the circumstances when I am going to crystallize this charge, when this charge can be crystallized? Now, to put it in a simple way, First, whenever the company goes into liquidation, because they are getting into liquidation, the banker or the charge holder would get threatened and he would immediately push for fixed charge conversion to it. Or when the company ceases to carry on business, they have not technically gone for liquidation, but they stop doing the business. Office is not open and branches are closed. Then he gets worried and he will insist for this. Or when the debenture holders take steps for the enforcement of their security, when they insist, the debenture trustees and all that. And fourth one, wherever there is a default in payment of EMI, so principal or interest. And the fifth one, on happening of any specified event. Now all the situations or any one situation? Any one situation out of it, it would result into crystallization. So again, I will ask you, when I say crystallization, what is getting converted to what? Floating charge is converted to fixed charge. Now, then let's move on. So this is what is the topic that we were discussing. Date of notice of charge. That is, from what day the notice of charge would come into the effect. Now, you tell me, from what day the notice of charge would come into effect? From the day of registration. So, the day when you are registering, from that day, it is deemed that, what is this date of notice of charge is, once you register the property with the ROC, then it is deemed that the notice is given to everyone else. So, that is anybody after the date of registration, anybody buying the property of after post the date, the buyer will never get the rights of it, because you are buying a wrong property, therefore you will not get. So indirectly the creditor is protected. That is the whole essence of this charges of registration. I repeat, because on this recently, of late, I'll show you the question, and these are the latest trend of questions. The difference between fixed charge, floating charge, time limits, these are all the traditional questions. But now he is getting into little more practical way of doing it. So I repeat, what do you mean by and what is the effect? Otherwise this looks even in your material just like a one-liner. So this is like, I mean, you may not be able to know the essence of it, but he is asking 5 marks questions based on this small concept. So even now, I would be focusing on those concepts where in a normal reading you would be missing it. That is the only purpose of you coming and sacrificing so many of your effective hours. So what is, I'll repeat, what is the purpose of this registration? Once it is registered, then ROC will issue CHG2. Apart from that, he is going to put it in the MCA portal for public visibility. And the expectation is, anybody buying any property of the company, he is expected to first go to the MCA website, check whether the property is a freehold property or charge is created. And without doing that, if you still go and buy the property, maybe whether out of ignorance, out of carelessness, buyer is not protected. So that is where a point will come when it is deemed that a notice has been issued to everyone else, to the buyer. So at what point? Because there are two. That is why I have been repeating and trying to make you sensitize. Whenever we talk about the charge, there are two cutoff points. One is creation of charge and second one is registration of charge. And creation of charge is when you enter into loan agreement with the banker. That is when you are creating a charge. That creating a charge is between the borrower and the lender. The government is not aware of it. So, and once you go and file CHG 1 or 9 with the ROC, then the government is informed. From that day, the government will take the onus and they try to protect the creditor. So keeping that point in mind, the ideal way how you should study this concept is, since there are two stages in charges, creation of charge and registration of charge, from what day this notice will come into picture? Is it from creation of charge or is it from the registration of charge? That is how it will come into the picture. Now you tell me the answer. From what day it will come into the picture? From the day there is a registration of charge. Now, I'll show you, there are intelligent questions being asked out of it. But first, let us complete this one round of it. And then I will come to the questions, which are way above from your general material. And then we will refresh. Then comes this. You have registered. And now you are going for modification. Now, just to bring back all your concentration, few questions, just to get you all into classes. As of now, we talked about 3 forms, CHG1, CHG9 and CHG2. Quickly, CHG2, who is issuing to whom? ROC is issuing to both the parties. And CHG 1 or 9? Company with ROC. Now, what are the two sections that are connected to registration of charges? 77 and 78. Now, where will the charge holder registration comes into picture? 78. So, technically, which section, whose obligation it is first to register? Company. So, therefore, which section reads relating to the company? 77. So, only when 77 fails, 78 would come into the picture. So, that's the logic behind it. Now, quickly again, what are the three timelines? Quickly. 30, 60 and 120. What are the three fees? Normal fee, additional fee and ad valorem fee. What do I mean by ad valorem? What do you mean by ad valorem? So the ad valorem is based on the value. So which means the first two are the normal, like say 2000 rupees, 200 rupees based on your authorized capital. And additional fee will always be like 200%, 100%, depending on how much there is a delay. It is like a double the amount, like how you pay late fees. So that will be negligible. Like 200 rupees, maybe additional fee is 100% of it. So 200 plus 200 late fees, that is additional fee 400. But if we fail in these two, then ad valorem will come. Ad valorem is based on the value, which could be percentage, like how you register your properties, percentage on the value of it. It can suddenly shoot up to crores of rupees. So that is how this point has come. Now, though I am going to cover, but now since it is a revision, I take that liberty. I've got three timelines, 30, 60, 120. What happens if I have not done the registration in these three timelines? That 78, would it come after 120 days? Or that is the charge holder registration? Or can you go and register even within this 120 days? Getting it? See, what I'm trying to question you logically is, when the company is not registering, then the charge holder will come. But when the company has to register, they have been given three timelines, 30, 60, 120. Now the question comes, when the charge holder should go for registration, is it necessary for him to wait till 120 and go after that? Or can you go even within 120? Within 120 itself. So that 78, it's not to be assumed, because he is trying to confuse you by asking all this. So this 78 can come at any point of time. So that is also both indirectly, these three timelines, one way to simple, are the timelines, whether it is registered under 77 or registered under 78. So both the one, whether company is registering or the charge holder is registering, registration had to be completed within 120 days from the creation of charge. But what happens if it's not done? We will discuss as a question, but because since you already listened to this in detail, what are the consequences of non-registration? So the consequences of non-registration are, whoever or the creditor to whom the charge is created, that creation of charge will lose its validity. Meaning the charge that is created, to put it in a more simple language, the creditor will lose the rights on it. So, but then will the borrower will have to repay the money, or is it that now we don't have to repay the money? Say charge is not registered in 120 days. Now, do the borrower is happy now that you don't have to repay the money? No. So, money becomes immediately repayable. But the only consequence is the creditor now will not be protected by the government. So, indirectly, the charge that you have created will not be recognized. So, those are the consequences. Now, let's come back. So, after you creating the charge, if at all there is any change in the agreement that you are entering, maybe you have taken additional loan, putting it in a common sense first, and then we'll see the technical names. Why this modification would arise? Like, I have taken 3 crore loan by giving this building of 5 crore to this, say, Canara Bank. But later to it, now I want more loan. So, whenever I take more loan, or whenever I feel like now 5 floors are there, now I have given it. But Why? I've already repaid. Now only 1 crore is outstanding. So I'm planning to sell the top 2 floors. But as long as, because since there is a building, it would come under fixed charge. In fixed charge, I can't sell without the banker's permission. So I go to the banker, I ask him, release the charge. Anyway, I have to pay you 1 crore. The 3 floors are sufficient enough. They are worth 3 crore. Release the top 2 floors. I want to go and make it. So whenever this part payment happen, part releases are happen, or whenever there is a change in the rate of interest and all that, any change in the agreement that you have entered, loan agreement that you have entered, again, the ROC also had to be informed, because at the time of giving CHG2, what he had kept you is that loan agreement. But any change in the loan agreement between the borrower and lender, ROC also had to be informed. That concept is what we call it as a modification of charge. So this modification of a charge, it can arise either by mutual agreement or by operation of law. Now, whenever there is a, what can be the scenarios for modification? Whenever there is a modification, what are the circumstances? Either change in the terms and conditions of the existing charge, or enhancing or decreasing the limits, or surrendering a pari passu charge, that is the proportionate charge, and change in the rate of interest other than the bank rate. This is a possible MCQ. I'll hold for a minute here. Any change in the rate of interest precisely on account of the change in the bank rate by the RBI policy, then I don't have to submit this modification. But if there is a change of interest other than bank rate, then it comes under modification. I have to go and register. Or whenever I ask for deferment of repayment schedules, because my business is not doing good, I go to the bank, I ask him now revise the due dates and all that. So any such repayment schedules are getting changed, then modification would require, or release of charge. Like I told you, I want to sell part of the building. So any one of this situation would result in modification. And this again, this chapter is there since for decades. Earlier in the old questions, there used to be heavy weightage on this. But now in the modern questions, you can take it. The focus is slightly on different ones. So otherwise, usually if you are referring to very old questions of 2015, 14 and all that, which your scanners will cover last 10 years, 15 years, you see some questions being dedicated on this. But now, not much. Only probable MCQ is change of interest. Whether I have to go and do it. If it is on account of bank rate, I don't have to do it. Simple reason. Any change in the rate because of the floating rate interest concept, then it will impact all the borrowers across India. So everybody need not go and do it. But if there is a specific change between you and one borrower and one lender, it requires it. So wherever there is a modification, they have to go and do it. But whenever this modification to the agreement are filed with the ROC will give you a certificate of modification of charge, which is CHG3. Now, I want to stop here. Now you tell me, what are the forms that we have learned first? CHG1 or CHG9, then CHG2, then CHG3. Now CHG2, who is issuing to whom? ROC to both the parties. Now CHG3, who is issuing to whom? ROC to both the parties. So CHG1 and 9, like company filing with the ROC, CHG2 or 3, ROC is issuing both to it. Now, what are the two sections that are connected to registration of charges? 77 and 78. Which comes first? 77. Under 77, whose obligation it is to create the charge? Companies. And if that fails, charge holder will do that under section 78. Now, whenever the charge holder is registering, who will have to bear the expenditure? First, the charge holder will bear, but he has a right to get it reimbursed by the company. So it is an obligation of the company to reimburse this charges. Now, quickly again, what are the three timelines? 30, 60 and 120. Three types of fees. Normal fee, additional fee and ad valorem fee. Now, let's move on. Then comes to satisfaction of charge. That is whenever, that is a clearance of the payment. That is almost like deleting the charge that I've created. So once the repayment is done with the banker, because as long as the charge is live, then in the MCA portal it will continue to show. So whenever I want to sell this building, People will check the MCA portal. They say that no, I will not buy because you already given this charge to the banker. So I want this ROC to delete that line. That is what we technically call it as a satisfaction of charge. So once this satisfaction of charge is done, ROC is going to delete the database. So your charged asset will become your freehold property. That is what is the essence of it. Now, what are the two sections that are connected? 82 and 83. Now, when the ROC will remove in two scenarios. When there is an intimation by the company, when there is no intimation by the company. Whenever there is an intimation by the company, ROC will obviously go and delete it. And whenever there is no intimation by the company, then that is when ROC is coming to know of it, he himself would delete it. Now, in this scenario of this, what is the process involved in this intimation by the company? Whenever the company settles the full payment of dues, then CHG4 will be filed by the company with the ROC. And once they file this, here there is a small change in the timelines. That is, they forgot to amend the timelines with regard to this satisfaction of charges. So maybe it is intentionally kept like that, or it is, but there is the registration 77 timelines have been changed, but they forgot to do that here. So that will result in small change here. So kindly focus here. Once you make the full payment, who will go and inform whom? The company will go and inform the ROC by filing CHG4. I've already repaid, now delete it. But the banker will not do it. Company may be bluffing. So whenever they say that I have repaid, the ROC wanted to get it reconfirmed with the banker. That is when he will issue a show cause notice to the charge holder, asking him, have you received the money? Shall I go ahead and delete the line? And that again, 14 days. All show cause notices, 14 days timeline. And if he confirms, yes, you can delete it, then ROC will delete this line and he will issue one certificate called CH5. Now, this is the stage where till here it was all right. You are learning CHG1, CHG9, it looks clear. But now slowly it is getting into little confusing areas. You need to have a clarity of it. Now, satisfaction of charge. Look at various charts for you to get hold on it. Now, or I will come from here. Show cause notice. Show cause notice in two different scenarios ROC will issue. Under 78, under 82. 78 he is issuing to the company in the case of registration, and ROC will issue to the charge holder at the time of satisfaction of charge. So, which comes under section 82. But always, to whomever it is issued, show cause notice is always for 14 days. Now, look at the chart and answer, then I will expect you to answer without looking at it. Now, what are the two sections that are connected to issuing of show cause notice? 78 and 82. Under 78, who is issuing to whom? ROC to the company. Under 82, who is issuing to whom? ROC to the charge holder. Now, and wherever it is issued, what is the length of that? 14 days. Now, the another chart. CHG4 and CHG5. CHG4, who is filing with whom? Company to the ROC. It is an application, basically asking for removal. And once after, now you tell me, show cause notice under 82, will it come before CHG4 or after CHG4? After CHG4. That is, you are filing CHG4 and then show cause notice is issued process-wise, technically. And if the banker says, yes, I did receive it, then ROC will issue CHG5. So, CHG5 ROC is issuing to the company and charge holder. I'll pause for a moment to get you control on this. There was one more form where ROC was issuing to both the parties, company and the charge holder. CHG2. So, what are the two forms that are issued by ROC as of now? Three forms actually, which ROC is issuing to both the parties. CHG2, CHG3 and CHG5. Now, which one is registration? CHG2. Then CHG3 is modification. And CHG5 is satisfaction. So, that is what are the three different forms. Now, look at this important one. Probably you would be missing a sight of the small difference, and he is asking questions to see whether you are sensible. This is the only tough point in this. Otherwise, remaining all points are clear. Now, registration we have revised it enough, 30, 60, 120 and all. There is no change. We need not go ahead again. But satisfaction of charge, same or not the timelines. So in the question that is being asked, look at it. Now hold for a while and look at it. Is he asking about the timelines for registration or for satisfaction? For satisfaction, the timelines are different. 0 to 30 days, normal fees, and 31 to 300 days, normal fee plus additional fees. So the question of ad valorem fees doesn't arise in the satisfaction of charge. So because the payment is already made, it is a procedural lapse. So he should have got that removed, but he didn't do it. For that, you don't punish him with crores of rupees of fine. So therefore, ad valorem fee doesn't come in case of the satisfaction of charge. So under satisfaction of charge, the timelines are only two. 0 to 30 and 31 to 300. Particularly this 31 to 300, keep a note of it. Why I am sharing that is, for you it looks like, okay, one more number, but why am I stressing so much? Say earlier, whatever you are seeing, 0 to 30, 31 to 300, same were the timelines even for registration. So, but they amended the left hand side, but they have not amended the right hand side. So to see whether you got familiar with this, there may be chance that he may ask you from the timelines for satisfaction of charge. So for satisfaction of charge, it is the same old timeline, 0 to 30 and 31 to 300. So, and there is no ad valorem fee. It is only additional fee that matters here. So this is what is the point on this. And then wherever there is no intimation, section 83, whenever there is no intimation, but whenever the ROC comes to know that payments have been made, but these people are not coming and filing it, but ROC want his records to be clean. So like what you call suo moto in a normal case. So 83 is almost like a suo moto case. ROC himself is going ahead and deleting the lines, and he himself will issue CHG 5 to all the parties. So it's a suo moto action by the ROC, not much of it. Then register of charges. This register of charges, there are two sections, 81 and 85 section. These are not important. The only two sections that are important are 77 and 78, which you may have to quote it in the answers. Remaining ones, it's your choice. You have time and you want to be, to the blunt of it, you can do it. Otherwise, also nothing much. But 78 and 77 and 78, you should have the grip of it. Then register of charges. The register, there are two sections. Under 81, there are certain registers which will be maintained by ROC. That is nothing but the database, what he will maintain at MCA portal. Apart from that, a register is also to be maintained by the company at their office. Now here, since it's a revision, the second one, that is section 85, is more important when compared with ROC. ROC is a government database. So 85 is important. That is who can verify, when it can be verified, and these kind of stuff. Now, first of all, the form number, making you familiar with MCQs. If you go back and look at one of your previous attempt, in that attempt, he had asked almost out of 30 marks of MCQs, almost like 12 marks were the MCQs out of registration of charges. So that is how he is going to literally create the surprise. But by and large, he will stick to the overall weightage that is given. So since there is a good amount of possibility for MCQs also to come, be familiar. Under 85, the company is supposed to maintain the register of charges. What is the form number? It is CHG 7. So quickly tell me, what are all the form numbers that you have learnt in an order? CHG 1, CHG 9, CHG 2, CHG 3, CHG 4, CHG 5, and CHG 7. So this register, the format is CHG 7, and what are the contents? Basically, it will have who is the creditor, that is who is the name of the charge holder, name of the property, date when it is created, any modification database, that will be there. And who will have to sign this? Every entry in this will have to be signed by the director. And how long you will have to preserve it? Now, this is important. How long you have to preserve it? The register will have to be preserved permanently, whereas the instrument of charges, that is CHG 1, 2, 3, 4, 5 and all this, these will have to be preserved for 8 years. Whereas the CHG 7 will have to be maintained for permanently. Then inspection. Who can inspect? member or creditor, any member of the company or creditor, they can come and verify without fees. Even third person also can come to the company and verify, but he will have to pay the fees. But when these people can come and check business hours, but in this business hours, in the exam, he is asking a teasing question. Business hours and working hours. Now, which one will be longer? Because just to see whether you got sensitized, because there are questions being asked on that. Is it to be verified in business hours or working hours? I'll clarify. Working hours is always for employees and business hours is always for customers. So whichever the topic it is, that is the general this one. Like you take a bank. Business hours are when you can enter into the bank and when you will have to exit. That is for the customers. And working hours are for the bank employees. So logically, now you tell me which hours will be longer. Working hours will be longer because before the customers comes, bank will be there. Bank employees will be there. They have to switch on the systems, open everything, download all their required softwares, be ready with the database so that whenever the customer comes, they start transacting. So this one, can they come and verify during working hours? The answer is no. They can come and verify only during business hours. So that point I'm elaborating so that you get sensitized. Now this is what I was asking you. What happens when I fail both in 77 and 78? No charge is created. When no charge is created, then the payment becomes immediately payable and no remedies to any of these parties. Creditor, though it is a secured asset, no lien will be given on the title deeds and all. It becomes indirectly unsecured loan. To put it in a simple, small language for you, the secured loan will become an unsecured loan. Apart from that, there are penalties. There are amendments, but you can ignore. These penalties, he is not asking too much of it. Then, one small question is there, that is rectification, section 87. It's a small one. What it says is, see, as of now, there are only 3 timelines for registration. Now, just to make a revision, now you repeat. What are the 3 timelines that I have for registration? 30 days, 60 days and 120 days. But for some reason, because 120 days is what? Roughly 4 months. And 4 months for a company can be a shorter period. Like say suddenly my company secretary resigned or there is a fire accident like in Taj, in the Mumbai and all that. Suddenly I had to renovate. So I've closed all this. So in 4 months time, particularly in these extreme scenarios, can be a very short time. Say, then I missed all 120. Then if I miss all 120, then what are the consequences? Then loan I have to immediately repay and the secured creditor will become unsecured creditor. So it creating a problem for both the borrower and the lender. That is when you need to have some way out, particularly when it is not your intention and you didn't do it willfully, but it had happened because of fire accident and all that. You couldn't complete within that 120 days. Then what is the way out? Because now 120 days is frozen. That is when this 87 would come into picture. So that is wherever there is an omission to intimate, that is either under 77 or 78, but that was not willful. It was accidental and it was inadvertent and there is a reason. So sufficient cause like fire accident, MD resigning, change in management, any such things, or there is a death of employee. So therefore, or there were strikes and lockouts, there was a corona type of restrictions, any such things. If we can prove it to the central government that these are the reasons, otherwise we never had any modified intentions, then central government can consider your application and then they are going to order the ROC, take this application, make a modification. So this is, now to repeat it, to put it in a simple way, there are 3 timelines for registration, making you clear with the concept. 30 days, 60 days, 120 days. What do I do if I missed all the 3 deadlines? But not intentionally, but unintentionally. So, because of practical problems. Then this section is very helpful. Then go to the central government, make an application. Tell them that these are the things that have happened. We never wanted to cheat the creditor. Then the central government, if they are convinced, they are going to order the ROC to correct, to make the record of these changes. So, this is, what is this last discussion that was required on this charges registration. There were some small points on intimation of receiver and all that, but that is okay, that you can manage it. Now, since that we have discussed. That's why it's a very small chapter. But only thing is certain questions. Now I will cover that exam-oriented questions, which is why you are here. So, but since I can't directly jump onto exam questions, I had to spend this 1 hour time on refreshing you. But hope, I mean, if you participate again by soul and heart, this chapter is done here itself. So, just that one day before the exam, even if you open, you are good enough to do it. So, kindly participate in the rapid summation of this entire chapter. Now, tell me, if at all I have to define a charge, what is the one word I have to write in my answer? Creation of interest or lien. Because why that definition of charge is important, he's asking, what do you mean by charge and how do you register the charge? So something like that. So whenever the word charge is given, then it is like creation of interest. Now, whenever I'm talking, I ask the same passion so that you can recollect. Whenever I am using the word charge, there are two important concepts. Creation of charge and registration of charge. Which comes first? Creation of charge. And then comes this registration. Under registration, two sections. 77, 78. So which comes first? 77. Who will have to register under 77? Company will have to register. Within what three timelines they have to register? 30, 60, 120. What are the three fees they have to pay here? Normal, additional and ad valorem. That they have to pay. But what happens if I miss all 120? Then no lien on that and the debt becomes immediately payable. But if it is missing the due dates was unintentional, then I'll go to the central government. Then what the central government is going to do? Central government can't change the database. Central government will order the ROC to change the database of it. Now, a quick recap of forms. Now, you tell me, what are the various forms that we have discussed? CHG1 or CHG9, CHG2, CHG3, CHG4, CHG5 and CHG7. Now, among all this, which is the register? CHG7 is the register. So, and remaining all are the forms, instruments of it. Now, I will ask you a simple question differently. How long I have to preserve my CHG1? 8 years. How long I have to preserve my CHG7? Permanently. So, because CHG7 is a register, CHG7 had to be maintained permanently. Otherwise, religiously you read, registers have to be maintained permanently and all that. But a combined question, that is where you may go wrong of it. So, this is, now one last question. What are the two types of charges? Fixed charge and floating charge. Now, which is converted to what? Floating is converted to fixed. What do we call that situation? Crystallization. So, and whenever there is a crystallization, then the floating charge is converted into fixed charge. So, now, let us look at the questions and whichever are the points that didn't come in the discussion, we will take a note of it and remember it for our revision. Now, this is a very traditional one, to be honest with you, not of a latest type. That is, if a registrable charge is not registered, the debt is not recoverable. False. Then what is the loss to the creditor? If the charge is not registered, is there any loss to the creditor? Yes. Is it that he will miss collecting the debt and all? No. Then what is the loss to the creditor? No lien. So, no lien on the recovery. So, the charge is created is ineffective. So, but he will always get the rights to recover. Only thing is no lien is protected now. Then, quickly answer them. $8 years. But which CHG document will have to be preserved lifelong? CHG7. That is nothing but the register. Is CHG7 maintained by ROC or the company? CHG7, is it maintained by the ROC or is it maintained by the company? Maintained by the company. So, what is maintained by the ROC is not CHG7. That is a database just for public display of it. So, CHG7 is the register maintained by the company. Then, 14 days. Any show cause notice, it is 14 days. Now, who will issue the show cause notice? ROC. To whom it is issued? Either to the company or to the charge holder. Now, in registration concept, whom the ROC will issue? Company. And in satisfaction of charge? Now that you are clear with that. Business hours or working hours? When the inspection can happen? Only during business hours. Because as a customer, as a third party, you are concerned only the business hours. Working hours are for the employees. Then, date of registration or date of creation? Date of registration. Now, I will just, there is a question, but since that question is too long, maybe some of you again will lose your concentration. So I'll put that in a simple way. So that 5 marks question, latest trend of questions on this topic. Say, there is a, say, A has taken a loan from SBI, follow it, A Limited, so that you won't have confusion. A Limited has taken, I'll write it here. Say, A Limited has taken a loan from SBI. Now, this loan is taken in, let's say, February 25, say, and this is one thing. And he has given his building 1. He has got his building 1 that is given as a security. So, when the loan is taken in February, he should have done it within 30 days or 60 days, or but he missed it. Now, and he went, there was a mess in the registration. They have registered only in, let's say, April 25, it got registered. But in the meantime, this A Limited went to, because he knows that this is not registered with ROC, he has taken another loan from HDFC, okay, and the same building 1, he went and taken the loan. This has happened in March 25, and this registration was done in March 25 itself. Let's say he has taken the loan on 1st March 2025, and the company is clear, and the banker was also clear. He made sure that by 20th, this charge is registered. So, to putting it in a simple way, from whom he took the loan first? SBI. Now, when the loan was taken, I want you to understand the facts. Kindly follow it, because this is the latest question that he had asked. I repeat it. Now, A Limited has taken 2 loans, one from SBI and one from HDFC. SBI, when he has taken the loan? February 25. But when it got registered? April 25. And the second loan he has taken by giving the same property from HDFC. When the loan is taken? In March. When the loan got registered? In March. Now, who will have the same building? So, if at all there is a default, which bank will have the right? Because SBI gave the loan first, but it got registered later, and you have a legal right. Whenever there is a delay, you are paying the fees. Once you pay the fees, it's legalized. It's like our LRS scheme or BRS scheme and all that, they come up for properties. So, 30 days, 60 days, 120. So, within that, they did it. So, first loan was given by SBI, but got registered late. But second loan was given by HDFC, but it got registered fast. Now, in the event of a disaster, who will have the right on the building? If you look at it, SBI gave first, but HDFC got registered first. Getting it? So, you simply by hearting this 30 days, 60 days and all that will not help you. Now, it is like a simple question. Either you get all 5 or you lose all 5. That's all. It's as simple as that. And you writing again 30 days, 60 days, 120 days stories and all, nobody is going to read. So, that's where there are questions like this, which we are getting into now. All these advanced questions, which you need to be good with. Now, so the first point I want you to make note of it is, which creditor will have the priority. So, whichever the registration happens first, so they will get. So, whether he is the second lender or he is the first lender. So, meaning, in our case, since HDFC charge was registered first, though he has given loan second, but he is the one who will get the first right on it. So, that is why it is very important for the charge holder that is the creditor. Though you got 120 days, don't be under the impression, don't be simply scolding the party, now go and do it, and he is telling maybe that party is buying time so that he can take a second loan. And if at all he takes a second loan from somebody, then though you are the first one to give it, but because of the delay by A Limited, now you lost the right. So that's where now the bankers are under tremendous pressure not to wait even this 30 days. They say that first you register and then come and show me, I'll transfer the money. So that is what is this. So for you, which comes first? Which creditor will have the, putting it in a one-liner, which creditor will have the overriding rights? Is it the creditor who gave the loan first or the creditor who got it registered first? So whoever got registered first will have the first right, not the creditor who gave loan first. So this is the point which you will never get in your material, but there are 5 marks questions being asked on it. I'll show you that question. So in that background, when this deemed notice, what is the logic for this? When SBI has given the first loan, why are you preferring HDFC? Why are you giving right? This is the point. Because deemed, it has been, the deemed notice would come into picture only from the date of registration. So this is the logic behind it. Then look at this question. I'll simplify. We will take only the important points of it, so that once you do this, complete the class, you are even covering your scanners questions as well. Now, H-Tech Machines Limited owns a plot of land which was mortgaged to Urban Commercial Bank Limited for raising term loan of 2 crore rupees. The mortgage was duly registered with the Central Registry. Now, I will simplify now in the interest of time. With whom you have to register? ROC. Now, in this case, whatever the loan they have taken, the mortgage loan, it is already registered with the Central Registry. So, when it is already registered with the Central Registry, do they have to come and register again with the ROC? That was a question. Now, do they have to do that one more time? The answer is yes. So, for this, a small background. Who is Central Registry and who is ROC? Now, this section 77 to 87 talks about registering with ROC. But the Central Registry is something the RBI had created. The central government, with the consultation of RBI, they have created for the bankers' sake. So there is a SARFASI Act, and there are many other acts under which this will come. Let's not get into it. So the Central Registry is a database maintained by the bankers themselves to see that, like the case that we talked about, any guy, forget about the registration of charges and all, no guy can take multiple loans by giving the same property. So you do have this registration of charges, but what happens? I take the loan, I got 30 days. So I take the loan by showing that this building, I enter into an agreement, but since I got 30 days to register, now tomorrow I'll go to the another bank. Our people are so clever, they process loans, loan applications from 2 different banks. Both of them are sanctioning. One I will register, one I will not register. So to see all these cases, it is a protection for the bankers themselves. So, and whenever you ask for a loan, he will not even look at ROC database. The banker will straight away look into Central Registry to see whether this company has taken any loans from any of the bankers. So it is the bankers' unions, it will be helpful for the banker. To sum it up, when it is already registered in the Central Registry, do I have to register with the ROC again? The answer is yes, because the access to Central Registry is given only to the bankers. So as a common man, I can't see the Central Registry. Whereas the purpose of it is to stop the buyers from buying such property. So therefore, even if it is registered with Central Registry, it is still required to be registered with the ROC. That is the answer to it. Then the next one. This is the summation I will tell you. The company had not registered and the charge holder had to go and register. Then the question is, whatever the fees the banker had paid, if you look at it, he is asking whether the bank can recover the fees from the company. You know it. Can the bank recover the fees from the company? The answer is yes. So that's a small answer to it. Now look at this. Another one. A charge was created by the Cygnus Software Limited on its office premises to secure a term loan of 1 crore availed from this Next Gen Commercial Bank through an instrument of charge executed by both the parties on 16th February, and inadvertently this could not get the charge registered with the concerned ROC within the first statutory period, And what is the first statutory period? 30 days permitted by the law, and the default was made known to it by the lending banker with a stern warning for immediate registration. Now advise the company regarding the latest date by which, that is, he is asking the date within which where he don't have to pay specific type of fee. What do you mean by specific type of fee? Additional fee or ad valorem? So this is where you lose the marks. Otherwise, you know all this. But small technical change, you will miss it. So when you say this specific type of fees, is referring to ad valorem fees. Because normal fee and additional fee are very normal. That is not specific. But specific type of fees is ad valorem. So the intention is, wherever you have taken this ad valorem fee, go and write the word this specific type of fees, so that you won't get confused. So indirectly he is asking, I've already missed 30 days, logically putting this question. 30 days I missed it, but I don't want to pay ad valorem. Then within what days I will have to pay? Within what days I will have to go and register? 31 to 60 days. That is when I have to go and do it. So 60th day is the last day. So from February, if you take 2 months time, you will get the answer. But the question is on this one. Then this one you will be able to answer, this ad valorem fee and all this. Now look at this question, 4 marks question. Rose Private Limited on 3rd April obtained 30 lakhs working capital loan by offering stock and accounts receivable as security and 5 lakhs ad hoc overdraft on personal guarantee of director. So how many loans this company has taken? 2 loans. One is a working capital loan, second one is a ad hoc loan. Working capital loan, what is the security given? Stocks and accounts receivable. And for ad hoc overdraft loan, what is given as a security? Director's personal guarantee. Now, again I'll go back. Is registration under 77 mandatory or optional? Ignore this difference of it. Answer from a normal point. Whenever I am creating a charge, is it mandatory for me to register or is it option to register? It's mandatory to register. Now they have taken 2 loans. Both the loans will have to be registered. Who has taken both the loans? Company has taken both the loans. Like I said, once you are an Indian company, wherever you take the loan, even in US by giving US property, US assets, you will have to register with him. So keeping that point in mind, since it is an Indian company, do they have to register both of it? Which one is not required? Second one not required. Why is it not required? Personal guarantee. So indirectly, even if it is the company which is taking loan, but if what is important here is what is given as a guarantee. So which requires to be registered, it is a company property is given as a security, then it is required to be registered. If directors' personal assets are given as a security for company loan, then company is taking the loan, but it need not be registered. So that is what is. So indirectly, if you go back and look at the definition of charge, it is creation of interest on the property of the company. So therefore, only company's assets are given as a security. This will come into picture. Otherwise, there is no need for registration. So that is the essence of it. Then this one, Beauty Limited obtained a working capital loan from Nationalized Bank against hypothecation of stocks and accounts receivable of a company. An instrument creating a charge was duly signed by the company and the bank. A company is not willing to register the charges. Now, what they need to do? It's a simple one. If the company don't want to register, then what are the options? Charge holder will go and register. Under what section? 78. That's all. And those are the points. Then I'll just connect 2 latest questions and then close this chapter once and for all. Now, look at this May 25 question. So, these are all the latest questions. So, and once you are able to answer them, then your understanding is up to this. Now, Vital Pharmacy Limited is engaged in the manufacturing of medicines to cure skin diseases. It has established a unit in Germany. It registered few patents in Germany and raised funds by creating a charge on stocks in Germany and the patent rights. Now, that is this is an Indian company having a branch in Germany, and they have created a patent rights, that is indirectly intangible assets, and where those are registered, patent rights are registered in Germany, and they have taken a loan in Germany. So the concept is an Indian company has taken a loan in Germany by giving an asset in Germany. Do they have to register here? The answer is yes, because once you are an Indian company, wherever you take the loan, ROC here need to know. But looking at it, it has nothing to do with India. Loan is given by a German bank and the asset is given of a German asset. But nevertheless, you are an Indian company, so wherever you create the charge, you have to do it. But what is given as a security is not a tangible, it is intangible asset. So is it required for security? So on this, now summing it up, what is required to be registered? As long as the security belongs to the company, it is required. It can be tangible asset, it can be intangible asset. But now you tell me, tangible asset of director is given as a security for a loan taken by the company. Not required. So it is not a type of security. It is who is the owner of that, whose property it is. If it is a company's property, you have to register. If it is a director's personal property, you need not register. It's as simple as that. That's all. So the rest and all is the same one. He is asking whether it is to be done and all. And look at it. He is asking, what do you mean by floating charge? And when it converts into a fixed charge and all. That is crystallization and circumstances and all is what you have to write it here. Now, this is I will explain the summary of it so that you don't have to read that lengthy one. But mind you, say this is September 24th, latest one for 5 marks. Since we don't have that much time to read all this, I will explain it in a simple one. Listen to it carefully. And there is an Excel limited. Follow it carefully. I am giving the summary of it. Imagine they went to the bank. They want a loan. Now they have given building as a security, loan agreement is entered and all. And what the bank did is they have sanctioned the loan. First, because normally what will happen, they sanction the loan. When did they sanction the loan? It is on, let's say, March 25. They sanctioned the loan, but they didn't disburse. Now, maybe while sanctioning, they put some conditions. I'm sanctioning the loan, but you have to do this X, Y, Z and all that. So for the company to fulfill all that conditions, it took some time. And in April 25, actual money got disbursed. Getting it? Say, I repeat. Bank had sanctioned the loan in March 25, but gave the first installment of that loan, disbursed that amount in April. Now, my 30 days starts for registration, normal fee and all, starts from when? Date of sanction or date of actual money flow? Because if I look at March 25, nothing had happened. It's a technical, they only gave letter. See, normally what happens, I'll tell you. To connect with you with this, I'll give one more example. Let's say I go to the bank. Now I want to construct a house. I ask them for a loan, housing loan for constructing house. The banker will see my credit portfolios. They see how much I am earning, what are the existing loans. Banker is willing to give it. But he said, now I am sanctioning this loan, provided you buy the land within 1 month or something like that. So if I buy the land within 1 month, then he will give you the money for construction. If I couldn't buy this, then the loan will get lapsed. So that sanction will get lapsed. That's how at times there will be a delay in sanctioning the loan and then disbursing the loan. Now in this case, for registration, what do I need to take? Now, is it the first disbursal or sanctioning point itself? So that is the small point without wasting much time of it. When my registration time will start, from the date of sanction. So from the date of sanction itself, that itself will be treated as a creation of charge, and my 30 days will start from date of sanction. Actual disbursements is not a relevant point in it. So that is, even if it's taking say 5 months for them to give the money, but still it requires to be transferred. So these are all the points that are important in this. Now let's quickly summarize this in 5 minutes time, and then we'll move on with the another concept. Now, you tell me quickly, what are the two types of charges? One is a fixed charge, the other one floating charge, which is converted to what? Floating is converted to fixed. Now, what do I call that technically? Crystallization. Now, after creating the charge, now whose obligation it is to register fast? Companies. What are the two forms he will be filing? CHG1 or CHG9? Within what time he will have to pay? What are the timelines for registration? 30 days, 60 days, 120 days. What are the three fees? Normal fee, additional fee, ad valorem fee. Now, and if the company is not doing it under 77, what is the next? 78. The charge holder can do it. Whenever the charge holder is doing it, now the ROC will issue show cause notice. Whom will issue the show cause notice? To the company. When will the ROC issue show cause notice to the banker? Satisfaction of the charge. So, under that, he is going to give this, the ROC show cause notice to it. Now, I will tell you the form. Think and tell me who will be filing with whom. Now, CHG2. ROC to the both the parties. CHG1. Company to the ROC. Now, CHG3. ROC to both the parties. Or if I ask you, what are all the various forms that are given by ROC to both the parties? CHG2, CHG3 and CHG5. So, now when after repayment of it, like CHG1, company will file one form with the ROC. CHG4. Now, how long I have to maintain CHG4? 8 years. Now, which is the CHG form which I have to maintain permanently? CHG7. And which hours I can verify the CHG? During business hours. So, who all can verify? Creditor, member and any other person, probable buyer, he can verify. Who can verify without payment of fees? Creditor and member can buy, but any third person, he can come to the company and do it, but he will have to pay the fees that is required to do it. So, with this, let us conclude this registration of charges. Take a quick break of 5 minutes, and then we will start up with some other chapters and start off our revision. So, just let's pause it for 5 minutes. Yeah, let's start. Okay, let's come back. Now, in this second session, we'll try to wrap up some of the small chapters which you are mostly comfortable and you have almost like 90% comfort on this. So we'll just try to see, we'll cover so that even in terms of number, we would have covered these chapters. This one will go very fast, but in the exam, don't underestimate them as well. Like even if you see May 26, there are still questions being asked on this declaration, prospectus, these small chapters. So let's quickly wrap it up. Now, in this declaration and payment of dividend, now the dividend includes interim dividend. There are two types of dividend. One is an interim dividend and the second one is a final dividend. You are very comfortable with this. Now, which one will be declared in AGM? Final dividend, and that is interim dividend is declared by the board of directors, whereas the final dividend, it requires the members' approval. Now, in this, or you tell me, instead of, because since this is a light topic, you must be familiar with this. Interim dividend is between interim dividend and final dividend, which is declared during the year. Interim dividend. Who will declare this? Board of directors. Now, which dividend requires members' approval? Final dividend. Now, who will decide on the final dividend? Who will recommend? Board of directors will recommend and members will determine. Now, when members are approving this dividend, what are the powers of members? Can they increase more than the directors, or can they reduce it? They can reduce it, but they cannot increase it. So those are the small points that we have discussed. And which can be revoked and which cannot be revoked. Interim dividend, since it's a board resolution, that can be revoked. But the final dividend, it cannot be revoked unless there are certain exceptions to it. Then whom do I pay this dividends? Say, generally dividends are paid to equity shareholders based on the dividend policy. They're also paid to preference shareholders on a fixed rate of dividend. And then there is a difference of cumulative preference shares and non-cumulative, which are familiar. So for cumulative preference shares, the dividend accumulates. So that is the difference between them. Now, the important one, the sources of payment of dividend, which is what he had asked in January 26. Now, from what sources I can declare the dividend? Now, when we talk about what are the sources for declaring the dividend, two sources. One is the profits of the company. Second one is money received from the government. So, when I say profits of the company, which profits of it? Say either the current profit or the previous profit or a combination of it. So I can declare either from the current profit, but if the current profit is inadequate, I can even go back to the previous profits, and that is as a combination I can do it. Apart from that, I can also declare this dividend from the money received from the government. Wherever this dividend guarantee schemes and all are there, I can do that. Now, this one, quite surprisingly, till this question was asked in January, it was a very negligible one. But in January 2026, he had asked a big question out of that. I'll just show you that question so that this is your January 26 paper. So, very first question out of this. ABC Limited, it's a latest question, so that I want you to be up to the trend of this latest questions. Otherwise, generally you miss the sight of it. You all are reading, but the most important point is reading to the expectation of exams. Now, ABC Limited, a listed company in the Indian manufacturing sector, has concluded its financial year ended 31st March 25. The company is now considering declaring a final dividend of 3 rupees per equity share with a face value of 10 rupees per share. So 30% they wanted to declare. Now, before proceeding, the board of directors seeks to ensure that the proposed dividend complies with all the relevant provisions of the Companies Act, particularly those related to the permissible sources and conditions for dividend distribution. Now, the summarized financial position of the company is given below. Revenue from operations, he has given the total revenue, and then he has given the other income, about 1,000 lakhs and all this, and which is the total, 10,000 the regular income and 1,000 this other income, 11,000 lakhs is the total revenue. And company has incurred expenses excluding depreciation of 8,000 lakhs and provided depreciation of 1,200 lakhs. So, and as per the schedule 2 of this. Now, the resulting profit, that is the profit before tax, stands at 1,800 lakhs with a tax provision of 450 lakhs, leading to a net PAT of 1,350 lakhs. Now, he has given all this. Then, in addition to the current year earnings, ABC has accumulated, that is indirectly he is talking about two profits. One is the profit before tax of 1,800 and second one is the profit after tax of 1,350. In addition to the current year earnings, ABC Limited has accumulated retained earnings of 2,000 lakhs from previous financial years and holds free reserves of 500 lakhs. So they had previous profit 2,000 plus free reserves 500. The company has 100 lakh equity shares and the total proposed dividend payout amounts to 300, because when they want to pay at 3 rupees per share, so the total payment had to be made is 300 lakhs. Now he is asking, based on the above information, analyze whether ABC Limited is eligible to declare dividends under the following scenarios in compliance with the Companies Act. One is out of current year profit, and second one is out of accumulated profits of the previous year. So support your answers with the appropriate 5 marks question. There is nothing in this. So that's why at times when you are lucky, miracles like this will happen. So only thing is, the simple question, what are all the sources? Yes, complicated by giving revenue, expenses, PAT, PBT, all this kind of stuff. But the point boils down to same thing. That is, whenever I am declaring a dividend, what could be my sources? My sources are the current year profit or the previous year profit. Now, when I say current year profit, should I take profit before the tax or profit before the tax and before depreciation? Because those are the details that he would like you to be familiar with. Now, the first one, which profit do I need to take? Obviously, before making any payment of dividend, you need to adjust it for the future losses, existing losses and the depreciation. So, depreciation loss you have to take, but it can be the profit before tax. So, indirectly, 1800 lakhs is what you are having PBT. Of course, that profit before the tax or after the tax is not a really big item, because even if I take profit after the tax, 1350 lakhs is your profit. But how much dividend you want to pay? 300 lakhs. So can you use your current profit? Obviously, you have enough money to do that. So, and then can you use accumulated profits of previous years? So actually there is no need, because current year profits are adequate. But in case you wish to use it, nothing stops you from using even your previous year profits. So the question is very, very simple, very, very negligible, and don't know why he had asked. So all that he is trying to ask is, can I touch for payment of profit, can I touch my previous year profits? So the answer is, that is where you can declare the dividends out of your current year profits or past year profits, or if current year profits are inadequate, you can go even for a combination, something from current and something from the past. So this is what is this simple question. Then another simple question is transfer to reserve. Now you tell me, do I have to transfer any amount to reserve before declaring the dividend? No. So earlier it was yes, but now it is the discretion of the management. So if they want to transfer, they can transfer. They don't want to transfer, they need not transfer. But he is asking that again for 5 marks question. And then in this, whenever we are talking about it, whenever the only condition here is, whenever I can declare the dividend out of past profits, but whenever I am declaring dividend out of past profits, 3 conditions are to be there. Now you tell me, since you already learnt it, 3 broad criteria: rate criteria, amount to be drawn criteria, and balance criteria. What is the maximum dividend I can pay in this case? Average of 3 years. So that is the rate criteria. Amount to be drawn, how much amount I can draw? 1/10 of paid up capital plus free reserves. So, and that I have to adjust for previous losses and all that. And then balance, how much will I have to keep it in the reserves at any point of time? 15%. So that is, I can't sweep off this reserves. So all conditions are any one condition. All conditions are to be satisfied, and whatever is the amount that is available, that I can use it out of past profits. But do I have to follow all this for the, if I am declaring the dividend out of current profits? Because probably that question what he had given in 2026, in the interest of time, I am not dissecting it, because we need to cover, at least touch few other chapters as well. But remember the difference. I can use current profits, I can use past profits, or a combination. But since question is asked in the 5 marks in the exam, you can slightly improvise and ask one more time. So what is the point to be remembered is, if I am declaring the dividend out of current year profits, I don't have to satisfy any rules. So I can directly declare. But these conditions would become a requirement only if I want to declare dividend out of past profits. That's all. So, but in the earlier case, in the question, exam question, Can I declare from the current profit? Can I declare from the past profit? From the current profit, directly you can declare because 1350 you had the profit and 300 is what you need. But whenever you want to utilize your past profits, then you have to look at it. 2000 was your this one, and then you have the free reserves, so then work out this amount to be drawn. So little calculations was required for this January 26 question. But at the end of it, only when I want to declare the dividend out of past profits, I need to satisfy these three conditions. Now, quickly you tell me, what are the two types of dividends? Interim dividend, final dividend. Now, where the members' approval is required? Final dividend. What are the powers of members in the finalizing the rate? They can reduce the rate recommended by board, but they cannot increase it. Now, is it mandatory that final dividend should minimum be like interim dividend? Like if I have declared interim dividend 10%, is it that final dividend should be minimum of 10% or should not exceed 10%? So, he is just trying to confuse. There is another year in which he is trying to confuse. What should be my final dividend? Now, is it supposed to be the minimum of my interim dividend or the maximum of interim dividend? There is no correlation. So, but just if you don't know what will happen, you keep thinking it. So, that's what it is. So, my final dividend has no relation to my interim dividend. My final dividend will always go by availability of profits. Current year profits, I can happily pay. If it is past profits, I have to touch. Then I have to see these conditions and make the payment. That's all. Apart from that, there is nothing much. Then, let's move on to it. Then timelines. What are the timelines that I have to keep in mind? Now, you tell me, what are the various timelines I have to keep in mind? What is the first timeline? After I declare the dividend, within 30 days I have to make. But within this 30 days, there is one more deadline. 5 days. Within 5 days, what I have to do? Transfer from a regular account to a separate account. So from which I should start making the payment of dividend. So from my separate account, how long the time is given? 30 days. So, and 30 days, the payments have not happened. Then what I have to do? Within 7 days, I have to move it to unpaid dividend account. So, and in unpaid dividend account, how long it will be there? 7 years it will be there. And after 7 years, where I have to move it? Investors Education and Protection Fund. So, then what is this 90 days limit? Within 90 days, after 7 days of it. Now, what is that I have to do? Is it that within 90 days after expiry of 7 years, I have to move it to IEPF? This 90 days is for what? Once you transfer the money to unpaid dividend account, within 90 days from that date, I have to publish in 2 databases. What are the 2 websites I have to publish this? One is the company's website and the other one is the government website, to put it in a simple way. So, I have to publish the details of what is the name of the people who have not collected, what is the amount they have not collected, and any other details, whatever like PAN number, whatever the company want to give, so that the people get notified, they can come and collect it. Now, so now quickly summarize. In the sequence, what are the number of days? First time limit, 5 days. After that, 30 days. After that, 7 days, then 90 days, then 7 years. After that, it will go to IEPF account. Now, once it is transferred to IEPF, can I withdraw that money? Yes. So, earlier the answer was no. Now, I can withdraw even the money is transferred to this one. Then, if what is this 12%? Since it is a small chapter, I want you to answer. What is this 12% rate of interest? Delays in transfer. Transfer from where to where? Unpaid to IEPF, separate account to unpaid dividend account, 12%. But if I don't make the payment of dividend, since it's a revision class, I'm taking little advantage. Now, if there is a delay in making the payment of dividend, then also I have to pay interest. That interest is what percent? Getting it? So, I'm holding it 15 or 18. Hold it. We'll come to it. And because I just want you to get sensitized, it is whenever you say 12%, that 12% is only for the delay in transfer. I'll show you through this chart itself. But let's finish this small discussion. So once the 7 years are over, then I can transfer to IEPF. Now once IEPF it is transferred, they can still withdraw. Then what are the sources of IEPF and all that? I'm not really getting into this. That you know it, you can do that. But in this, the biggest point here is you can claim the refund even after it is transferred to IEPF account. Now, then what is the membership number and all? Those are the negligible ones. So then what do I do? This section 126 is asking questions. That is, if the share transfers are kept in abeyance, that is, for some reason, if the shares are held in abeyance, that is registration of I'll reframe the sentence. If there is a delay in transfer of shares, then what should I do? So then the provision, I'll straight away put it. Say somebody had requested for transfer of shares, but the company wanted little more information. So now in the meantime, the company had declared dividend or the company had declared right shares. Then what they have to do? So will they give it to the transferor or will they give it to the transferee? So that is what is the case here. Now, if it is a dividend, it will be transferred to the unpaid dividend account. So it will neither be given to the transferor nor transferee. It will be transferred to the unpaid dividend account. But if it is relating to right shares or bonus shares, then I won't transfer it to unpaid dividend account. Rather, I would keep it in abeyance. This situation would arise, like take an example, I want to transfer my shares in the name of my son. Now, when I submit it, the company wanted to know who is this, or maybe forms are not being submitted properly. They want us to submit. So I'm resubmitting. This is going on. But in the meantime, the company declared dividend or the company declared right shares. Now, whom they should give? Now, do they have, because since the transfer is not complete, will they treat me as a shareholder, ignoring because transfer has not happened? But since the transfer application is already made, now will they give it to the transferee? It is only pending formalities. That is what it is. So it is wherever your transfer applications are pending. If it is relating to dividend, then they will transfer it to unpaid dividend account. That is, they don't pay to the transferor, they don't pay to the transferee. Or if it is to the right shares or bonus shares, again, they won't give it to any one of them. They will simply keep it in abeyance. And once the decision is final, they will make the payment to it. Now, that interest one I am trying to confirm. So, wherever there is an interest, 12% and 18%. So, 18% for non-payment and 12% is for delay in transfers. Now, the last topic of it. It's a very small chapter. There is nothing much. Now, under section 127, because whenever there is a delay in payment of dividend, then the directors also will have to go to jail. There is an imprisonment and all this kind of stuff. But when the exemption will be granted to them, this is where you had your previous year question. Very small chapter this is. Now, then what are all the exemptions from them? First one is dividend could not be paid by reason of operation of any law. So, where because of any other law they could not, then they won't be punished under 127. Then the second one, shareholder had given certain directions, but the company could not comply with that, in which case the company should have communicated to the shareholder. Like he wanted to transfer to one account, but that account is not functional, there is a technical issue, whatever it is, then it is not the company fault. Then the third one, dispute regarding the right to receive dividend. Wherever the company has not paid because they have some doubts on is he the real owner. So then they will not transfer to, they will not make the payment to him, they would have transferred to unpaid dividend account. So, and the fourth one, dividend has been lawfully adjusted against any sum due from the shareholder to the company. So, basically for call scenarios, can they adjust? The answer is yes, they can adjust. And wherever that lawful adjustments have happened, then it will not be treated as an unpaid and the directors are not punished because they are trying to adjust this money. And the last one, any other reason for the failure to pay dividend within the prescribed, which is not at the fault of the company. So, in any of these 5 cases, companies will not be penalized. Otherwise, company will be penalized under with these provisions. That is, for not making the payment of dividend within 30 days, there will be an imprisonment up to 2 years. Plus, for every day of default, 1,000 rupees they have to pay. Plus, company will pay the simple interest of 18% per annum. So, this is what are the punishments for failure to make the payment of dividend. So, in all this, It's a very simple chapter. What are the sources? What are the timelines? And what are the punishments if you don't make the payment? What are the exceptions? If we cover these 4 angles, then this chapter is done. There is nothing much with regard to this chapter. So I'm moving out of this chapter. Now we will come to this slightly the tougher chapter for you. So, and unfortunately, this is an important chapter which is asking, that is acceptance of deposits by the companies. Now, this one I will go little slow, because whichever I feel you can manage it, I will take it fast. Whichever I feel I will have to hold back, I will hold back. Now, this acceptance of deposits by companies, remember, there is a frequent question. Point 1, to alert you, you may not like reading this chapter because it's all not a student friendly, but you have no choice. Because if you take last 4 attempts or 5 attempts, there is a regular question. So there is a question in almost every attempt. So you have no choice but to read this chapter. So, and it's a small chapter, but little confusing chapter. Refresh as many times as possible. And it is little longer, and it is confusing if you try to mess your mind with everything. But if you go for a selective reading of it, what to read and what to ignore, then this is going to be a manageable one. Now, under this, explaining it, there are broadly 3 types of questions that will come. First one is, what do you mean by a deposit? That is, he won't even get into what is the percentage I can accept, from who can I accept, members, conditions, all that. He is not getting into it. The first essential question, is it a deposit? Because there has been a significant change in the definition of deposit. So therefore, the one big question that he will ask is, what is the definition of deposit? That is one set that you have to be good with. And once it is confirmed, then the second level of question is, who can accept deposits and how much percentage? So that is from members, how much, and the public how much, and all that. And then the third one is the conditions, what you will have to satisfy. Some small miscellaneous question. Joint name should be in how many names, and these kind of miscellaneous points. So by now, if it is an MCQ, you are getting questions from this definition of deposit, short answers and all. If it is a 5 marks question, you are getting it from the percentage, how much you have to accept it. Now, let's get on to the definition of deposit. Now, this definition of deposit, it is a simple definition. See, earlier, that is now, there is a change in the definition of earlier times and the current times. Now, the word deposit is simple. Any money that you receive in any form is what is called as a deposit. Whether you are accepting it as a deposit, or you are taking it as a loan, or you are giving any other name to it. But any money received by a company from anyone is a deposit. But why they had this conditions is, you know that since it is a revision, I am just bypassing. So under this Companies Act, not every company can accept deposits from everyone. So there are limitations. Certain companies can accept from members, certain companies can accept from public. So there are differences and how much you can accept. In that background, is it a deposit in the first place? That is what is a significant point. So to come back, deposit, the definition is simple. Any amount received from any person, whatever the name you call, you yourself are calling deposit, or you call it as a loan or any other form, it is a deposit, unless it is exempted. So all your effort should be to know what all that exemptions that are in the Companies Act. Even when you are trying to define, the definition that you are seeing is what you have to quote fast, saying, because it's like all inclusive definition, saying everything is a deposit unless it is exempted. So all your struggle is, the given scenario, will it fall under exemptions? That is what we will have to look at it. Now, look at that exemptions, what he has given. The first ones, though there is a long list, but try to summarize and put them into a group. Whichever is important out of this, I will tell you. Even here again, in this chapter, more than the content, I have to spend time in building up your confidence. So, because as a student, you read it, but are you confident in answering the question? Somewhere mind will not accept. That's where pick and choose. Now that you have got hardly days left, not even months left, days left for the exam, hand pick what are the points that I have to read from here and revise multiple times. Remaining ones are automatically under your control. So Whichever is important for you, I will alert and I will spend time. Otherwise, I'll move on. So coming back to it, anything received by the company from anyone is a deposit unless it is exempted. What is that exempted category? So first one, any amount you receive from central or state government. Any money you receive from central or state government, you need not worry, that is not a deposit. Everyone can accept it. And then similarly, any money received from a foreign government, like Indian government, foreign government, any money you receive from foreign government is also exempted. That's a simple way to look at it. And the third and fourth ones are from banks and PFIs. So if you look at the four long list, it's simple. First is Indian governments, second is foreign government, third one is bank, and fourth one is PFI. Any amount you receive from them, whether a loan or anything, it is not a deposit. Then any commercial paper, as per the provisions issued by RBI, is also not a deposit. Then sixth point is all right. That is, any money you receive from another company is not a deposit. The seventh one, it is important. We will have to stop here and discuss. That is, whether, since the definition is any money I receive is a deposit, then what about share application money that I receive it? So, or calls in advance. Now you tell me. Oh, since it is a revision, I take that liberty and then I clarify myself. When a share application money will become a deposit? First, is share application money a deposit? Let's go back to the definition. So, since I see that not so comfortable, I will explain myself. Since any money received from anyone is a deposit, that is why there was a question, can share application money be considered as a deposit? The answer is no. So, what they said is, but it is conditional. Any share application money you received is not a deposit, but it will become a deposit if you are not allotting the shares within 60 days, and whenever you decide you don't want to allot within 60 days, then you should refund. How many days are given for refund? 15 days. So now one simple logical question, when will share application money will become a deposit? On 60th day or on 75th day? That's all, 75th day. That is, 60 days is the timeline for making your judgment, whether to allot or not to allot. So, can I receive share application money? Will it be a deposit? No, it will not be a deposit. So, for this entire big chunk of explanation, one small one-liner is, share application money would become a deposit after 75th day. That's all. So, till then, it is not a deposit. So, that's a simple way how you can remember it. Then, but the important point here is, like, that's why I picked up this topic, and before this, or rather, I picked up that payment of dividend chapter. The reason is, there is a slight, the last topic of it, and almost the first topic of it, be clear, relate these two and be confident. Otherwise, you get into a wrong explanation. See, all that I'm trying to say is, I'm trying to focus on this point of adjustment for any other purpose. Now, listen, each chapter is, when you read it, each chapter, you are comfortable. But here, you got to be slightly careful to avoid probable confusion among the students. I have not made the payment of dividend, then am I liable for punishment? The answer is yes. So, that is 2 years imprisonment, 18% interest, all that we talked about. But can I set off that dividend against any collections that I have to receive from the shareholder and all? The answer is yes. So, that was a fourth point. Any lawful adjustment from unpaid dividend is permitted. Similarly, a person had applied for share application, shares, and he has paid share application money, and he's also happened to be my customer. Now, within 60 days, I decided not to allot the shares. Then, in next 15 days, I'm supposed to refund. Then my accountant told me, the same guy bought some goods from us and he's not paid that money back. Now his share application money is there. So it's a lawful adjustment. Now, because he has to pay me for the services he has received, now I have to refund him the share application. Now, can I adjust this money, any money from the share application money? That is where your payment of dividend act and your acceptance of deposit acts differs. So, otherwise, when you read it individually, it will not strike that contradiction. So, to cut short, can I adjust any money that I have to receive from the member towards this, towards unpaid dividend, the answer is yes, you can adjust. But the share application money, I should not. So whatever I have to pay, I have to pay. But he also had to pay me something that you collect by separately, but you cannot adjust. So in the payment of dividend chapter, it is permitted. In the acceptance of deposit chapter, any kind of adjustments, book adjustments you wanted to make it, mutual indebtedness, that will not be treated as a refund. So you took it as a share application, you refund him as a share application. That is what is. Otherwise it's okay. But in your mind, I want you to tell, make it one point clear, because both the questions are being asked. So adjustments to share application not permitted, adjustment to dividend are permitted. That is the one-liner that you can take. Then director. Now, let me see how much you remember. Because since it is a revision, I am taking that liberty again. Any money received from a director, is it a deposit or not a deposit? It depends on the source. So, that is, what is the source? Probably you can, summarizing all that points, in the interest of time, I am directly getting into the summary. Any money you receive from a director of a company or relative of a director from a private company, to conclude whether it is a deposit or not, I have to look at these three sources. One is, if he is giving money out of what he had borrowed from others, then it is a deposit. Or is giving the money out of loans which he had accepted and then giving it to me as a deposit, then it is, for me also it is a deposit. But then when it will not be a deposit, if it is out of other sources, that is, if the director is giving the money out of personal sources like gift from mother and all this kind of stuff, then it is not a deposit. But if he is borrowing from somebody and then giving it to you, it is a deposit for you and you shouldn't accept it. So, or you have to accept within the limit. So, to cut it short, now you tell me, though there is a big length discussion, but as a one-liner, now I ask both the questions. When a share application money will become a deposit? One-liner. After 75th day of not refunding. Then when a director, money received from director will become a deposit? If it is from, what are the two probable sources when it becomes a deposit? Either he has borrowed and given it, or he has accepted as a deposit and then giving it to him a deposit. So, but if it is from many other sources, like personal gifts to him or his personal savings and all that, then it is not a deposit. So, indirectly, if the director being used as a middle person to bypass the provisions of Companies Act, then the Companies Act is saying you are using him only as a pawn, so it is. But if the director is, like suppose I will ask you, the director has given money out of his salary. Because as a director he is getting salary, now company wants some money, so the director gave from his salary. Is it a deposit or not a deposit? That is where you read all this, but you can still get confused. So, remember, then how do you remember? Don't read the third point, though that is what is asked in the exam. Read it in the other way around. That is, when a direct money given by a director will become a deposit. With the money taken from a director will become a deposit if he is taking loan from somebody and giving it to you, or if he is accepting as a deposit and then giving it to you as a deposit. In these two cases, it becomes a deposit. Any other money, that is, if the director is giving from his own pocket, not taken from third person, either as a borrowal or as a loan, then it is not a deposit. But what if he is taking from his relatives as a gift and giving it to me? So, gifts comes under personal source only. So, only restriction they are saying is, director taking loan and giving it to the company, then it is a deposit, and director taking it as a deposit and then giving it to you. So, the better way to analyze and a simple way to analyze is, first two cases you remember, when it is going to become a deposit. If he has borrowed and giving it to it, or if he is taking as a deposit and giving it to it, it's a deposit. In all other sources, it's not a deposit. The only probable one you get confused is, instead of taking from somebody as a gift, somebody as a loan, he has taken as a gift. So, gift is a personal one. So, therefore, it is not a deposit and all that. Like say, this is how it comes. 3 lakhs received by a private company from one of the relatives of a director. The said relative has furnished a declaration that the amount was received by him from his mother as a gift. So gift from the mother and then giving it to the company, it is not. When this would have become a deposit for the company? If the director had two scenarios. If he had taken from somebody as a loan or if he had taken it as a deposit, then it would have also become a deposit for this company. But here, just to make you more sensible, but it is not from the director, it is from the relatives of a director. Because the small things can make you either gain or lose the marks. Director is all right. Is relative of a director is a director or he comes under public? Director is all right. But he's not talking about director. He's talking about relatives of a director. So the difference is just slightly, because these are the small advance points you need to. Only for private companies, even relatives from a director is also treated as a director. So, but for public companies, say in the same case, suppose instead of this private company, suppose if it says it is a public company, then you don't analyze mother's gift and all that. A relative is a third person. He is like any other person from the public. So if it is a public company, then only money received from director is exempted. But if it is a private company, any money received from not only director but relative of director is also exempted. So that's a simple way how you can remember this. So whenever you see the word relative, you have to relate it to the word of this private. So that is what is the point, just out of caution. Then let's move on. Then any bonds and all that, this is okay. That is any secured debentures, say, or I'll put that way, simple way. What about debentures? Because any loan you take is also a deposit. Debenture is also a loan. Is a debenture a deposit? Because straightway anyway you will learn it. But let us learn it in a simple final summary type. Can a debenture be also? Debenture is also like a loan. It's a debt instrument. So can a debenture be treated as a deposit? So answer is simple. Though you can read all this and try to relate, simple way to remember is, if it is a secured debenture, it is not a deposit. If it is unsecured debenture, then it is a deposit. That is the simple way how you can, in a student-friendly language, you can. Otherwise, you get confused. Say secured, tangible, intangible, first charge and all that, you get confused. But broadly, to remember it, any secured debenture is not a deposit. Unsecured debenture is a deposit. That is what is the simple way to remember it. Now, employee. Any money received from employee, is it a deposit? Only when it exceeds 6 months salary or annual salary? Annual salary. So now 3 points again I will hold back because this is a tough chapter. I will not rush it like our payment of dividend, because that chapter anyway you can manage, but this one I'll hold back. I'll try to give you as much as comfort. Now I will ask you repeated questions. What is deposit? Now you tell me. Any money received from anyone in any form, 3 forms basically. Loan, deposit or any form is a deposit unless it is exempted. Now I will start asking pointed questions. Is share application money a deposit? No. Only when will it become a deposit? After 75 days of it. Then the second question, but in that again, what if that share application money, instead of refunding, it is adjusted against lawful adjustment against any other dues? Not permitted. That is, though you have every right to adjust lawfully, but for the purpose of this, that adjustments are not permitted. It will not be treated as a refund and it will continue to be treated as a deposit. Then we talked about directors. Now whether money received from director or I'll reframe that question. When a money received from a director will become deposit? If he is taking a loan and giving it to the company, or if he is taking as a deposit and giving it to the company as a deposit, then it will become a deposit. But any other source of it, we will not know. But how the company will know how he is giving you? declaration. So based on the self-declaration given by the director. But is it from, then what about relative of a director? For private company, it is one and same. So, but for public company, relative of a director is a public. So that is the simple way to look at it. Anyway, for you, he is not testing you to that level. And then money received from employee. When it will become deposit? If it exceeds the annual salary under the contract, then it is a deposit. So up to annual salary, it is not a deposit. Exceeding annual salary, it is a deposit. So, but up to the annual salary, but he has given for interest. Getting it? Say, that is, employee is giving it up to annual salary. This is a simple way what we take. Up to annual salary, not a deposit. More than annual salary, deposit. Now, take an example. What he is asking simple questions. 2,50,000 received from R, an employee of the company, who is drawing annual salary of 2 lakh rupees. Is an employee, his annual salary is 2 lakh rupees, but he has given 2,50,000 to the company. Is it a deposit or not a deposit? Deposit. So, now I will slightly change. Look here, he has not asked you thus far, but he can ask you latest trend of questions. What he has given is 2 lakhs, but his annual salary is 2,50,000. Not a deposit. But when he is giving it, he has given at an interest of 8%. I repeat, his annual salary is 2.5 lakh, but what the money he has given is 2 lakh with at an interest of 8%. Is it a deposit or not a deposit? So here, what I want you to remember here is, whenever you read from employee, 2 points will come into picture. Now, how he has given this? Now, has he given it as a non-interest bearing deposit or an interest bearing deposit? If it is an interest bearing deposit, then it is a deposit. So, if it is a non-interest bearing deposit, then you will go back and see, then how much has he given? Up to the annual salary or above the annual salary? So, if it is up to the annual salary, not a deposit. Above the annual salary, it is a deposit. So, to cut short, now you tell me, though it looks a little confusing, but no, there is no confusion. Amount received from employee, what are the 2 things it has to satisfy to call it as a not a deposit? Up to the annual salary. Second condition, non-interest bearing. That is the better way to learn it. That's all. So take that as a 2 small points. It will become simple. Then let's move on. Then advance from suppliers. Now, can I take, because taking money from anyone is a deposit, then what if I'm taking money from suppliers and all this? So advance from suppliers, I'll straight away put this rather than confusing you with all these technical words. When it will become a deposit, when it is not a deposit. Then I have to see advance I've taken for what? Is it for immovable property or is it for goods and services? If it is for goods and services, if the services are provided within 365 days, my 365 days starts from, logically, date of advance. So I have taken the advance say for supply, but I have not supplied for any year. Then it becomes a deposit. So that is what it is. For goods and services, up to 365 days. If it is for immovable property, so then 365 days will not come. The logic I will tell you. Say I want to buy a flat in this. Now, say it is a company. Now I paid some deposit money to book the flat. Then that is why, but for the completion of this buildings and all this immovable properties, it takes years. So 2-3 years. That is why the 365 condition is not there. Then what is the maximum condition as per the agreement? So if the supplier had agreed to hand over the property in 2026, he has not handed over the property, then whatever the advance I have paid to him will become a deposit. So 365 days will not come into the picture. It is as per the date of agreement. But here, there is also one small extension. What if the advance for subscription is towards publication for print and electronic media and all that? So in which case, it is not 365 days and all. On receipt of publication, if it is adjusted, then it is not a deposit. Or if it is not done that, then the publication is not done, then you should have refunded within 15 days of due date. Then it will not become a deposit. Otherwise, it will become a deposit. Indirectly, 365 days rule will be applicable only for goods and supplies. So it will not be applicable for immovable properties and for advances for publication. That's all. Because in these two cases, the amount 1 year may not be there. So it can be like, say, you are an author. Now I'm giving you some money for writing a book on it. You may complete it in 2 months. You may take 2 years. So that 365 days is not very relevant, right? Real estate. The common point that you can see is 365 days is applicable only for goods and services. It will not be applicable for immobile properties and print publication. So in which case, as per the agreement, it goes. That's all. That is the simple way to remember this. What are all treated as not an advance. Then the next one, promoter. Now, this point is asking, what about if the money is received from a promoter, not a director, from a promoter? Then any money you receive from a promoter will not be treated as a deposit if 3 conditions are included in it. One is, it is a margin. It is a requirement. The promoter had given the money because it is stipulated in the lending agreement where the company had borrowed as a margin money, or the loan provided by the promoters themselves or by the relatives, or both, and such exemption shall be available only till such time the loans are not repaid and all that. Now, I'll stay back and I will talk about it. That is, any money you receive from promoter, is it a deposit or not a deposit? If these 3 conditions are satisfied, it is not a deposit. What are the 3 conditions? I'll put that in a student-friendly language. The money given by the promoter was really required based on a loan agreement, and the money was actually given by the promoters themselves, not that they borrowed from somebody and passing it on to you like directors. And the third one, that money they kept it only till the time the loan was active. And once because they are giving the money only because of the loan agreement. If I am repaying to the bank, then the promoters also should have withdrawn the money. I repay to the bank, but I am still holding the promoter's money, it becomes a deposit. So promoter's money will become a deposit after the loan is repaid. The original loan for which you have given the margin money is repaid, you are still holding the money, then it becomes a deposit. So these are the major points. Last point also we'll discuss, then don't worry, I'll summarize what are all the various points that we have discussed. And the last one is startup company. Now, for startup company, any money they receive will not become a deposit. There are certain exemptions. What is that exemption? That is, the money you have received is 25. Now, is this 25 lakhs? You tell me. Is it the minimum amount or maximum amount? Minimum amount. So, minimum amount you have received is 25 lakhs. That too you have received where the repayment period is not exceeding 10 years. So, and then it is received in a single tranche. Once these 3 conditions, that is, amount is more than 25 lakhs, repayment period is not exceeding 10 years, and it is received in a single lot. Single tranche is single lot. Then it is not a deposit. Otherwise, it would become a deposit. Now, look at one example that he has given, exam question, then we will look into it. After that, I will give you comfort and summarizing that key points. Let's complete this. Discuss the following situations in the light of this deposit provisions as contained, whether it's a deposit or not. Samit, one of the directors of Jor Technologies Limited, a startup company, requested his close friend Ritesh to lend to the company 30 lakhs in a single tranche by way of convertible note for a period to be repaid for 6 years. What all first we have to see? Amount. Amount should be more than 25 lakhs. Here it is 30 lakhs. Then all the money should have been received in a single lot, not like small settlements. Here he has given it in a single tranche. Then repayment period.
maximum repayment period should be 10 years, but here it is 6 years. So all the conditions are satisfied, and the last condition, what he has given money should be in a convertible note. That is, as of now it is a money which is going to be converted into equity shares. So when all the 4 conditions are satisfied, it will be not treated as a deposit, otherwise it will be treated as a deposit. Now looking at this, you tell me, summarize, when it will not be treated as, what are the conditions for a startup company to not to treat it as a deposit? Condition 1, not to be treated as a deposit. Amount should be greater than 25 lakhs. Second condition, single tranche. Third condition, repayment less than 10 years. And fourth condition, convertible note. So take that in that way. It will become more easy for you. Otherwise, how many ever times you read, your confusion will still continue. So 4 conditions are to be satisfied. I am repeating because since there is a possible confusion and it is an important topic. 4 conditions if you satisfy, any money you receive from a promoter will not be treated as any money you received by the startup company will not be treated as a deposit. Now you tell me, what are that 4 conditions? I want you to answer. Now, condition 1, amount should be greater than 25 lakhs. Second one, single tranche. Third one, repayment less than 10 years. And fourth one, convertible note. Any one condition or all conditions? All conditions are to be satisfied, then it is not a deposit. Now, with this, almost this definition of deposits is over. Now, let us go back. So, let us go back and try to revise. Now, because that is why you are here, to get some comfort apart from what you are trying to draw by your own reading. Now, you tell me, what do I mean by deposit? Any money received in 3 forms. Loan, deposit or any other form is a deposit unless it is exempted. Now, then he started giving exemptions and all that. Now, I will raise one point. Now, you tell me when it will not be a deposit. Now, is share application money a deposit? No. When it will become a deposit? After 75th day. You are not allotted, not refunded. Then after 75th day of receiving the share application, it will become. Then what about calls in advance? I have received calls in advance, but not adjusted. Same case, either share application money or calls in advance, it is one and same. Now, money from directors. When it will be treated as a deposit? He is taking it as a loan and giving it to the company as a deposit, or he is taking it as a deposit and passing out to the company as a deposit, then it will be treated as a deposit. But what if the director is getting it as a gift from his relatives? Not a one. Now, relative of a director can give money to which company? Private company. So, for public company, relative also becomes a public. So, it will not be covered in it. Then, employee. There are 2 conditions that are to be satisfied. Up till annual salary, non-interest bearing. Both the conditions are any one condition. Both the conditions, then it is. Then money received from promoters. 3 conditions. It must be a margin money, putting it in a simple way. That is, it is as per the terms of the loan. Second one, promoters themselves, or money is given by either the promoters or relatives of them, the promoters. And the third condition, that money will not be treated as a deposit till the time the loan is repaid. Once the loan is repaid, you are not refunded the money to the promoter, it becomes a deposit. So, these are the probable conditions. Then the final one, startup company. 4 conditions, it will not be a deposit. More than 25 lakhs, single tranche, repayment up to 10 years, and last one, convertible note. All conditions are any one condition. All conditions, then it is not a deposit. So, this is how we will have to, what are the important points on the definition of deposit. Then, coming to this, now this is a simple one. Your only tough time is in learning what are the exemptions for deposit. That too, if you prioritize what we have discussed, you are more or less in the safe zone. So, then it comes to it. Then what are the conditions and what are the limits and who can accept what? So, for the purpose of this, companies are classified into 3 categories. So one is a private company, second one is a public company, and third one is a eligible public company. Now you tell me, who all can accept from directors? Everyone, all three can accept from directors. Who all can accept from members? From members. From members also all can accept. Then who can accept money, deposits from public? Eligible companies. So I repeat it. Why do we classify them is who is eligible to receive deposits from whom? So from directors and members, all three types of companies are entitled to accept it. But from public, it is only the eligible public companies which are allowed to accept this deposits. Now, what are the two variables? What are the conditions to be satisfied to call a company as an eligible company? Two things, net worth and turnover. Net worth is 100 crore and turnover is 500 crore. Now both the conditions are any one condition. Any one condition. Now I want you to answer. Now listen carefully. What are the three types of companies that we divide here? Private, public, eligible. Now who all can accept, all three, I'll reframe that question. I'll reframe. All three companies can accept deposits from whom? Directors and members. But where is the limitation? Public. Who can accept deposits from public? Only eligible company. Now, what are the two conditions, two variables for eligible company? Net worth and turnover. What are the limits? 100 crore, 500 crore. Both the conditions are any one condition. Any one condition. What if these conditions are satisfied by a private company? Can they accept from public? The answer is no. So indirectly, though they call eligible company, it must be first a public company. So indirectly, there are three conditions. It must be a public company, and then it must, the net worth and turnover criteria will have to tally with that. Then only they can accept money from this public. Then I will straight away get into this eligibilities of it. Now before that, small important 2-3 charts if you see, even when you read, don't bother yourself. As I said, strategize your preparation of this in a revision in these two modes. First is, what is the definition of deposits? And don't take your material and keep on reading it. It will add more and more confusion to you. So, and read only the exceptions which are exempted as a deposit. Like when what about share application money? What about directors? What about employees? What about promoters? What about startup private? So 5 cases. If you get the grip of it, then you are done with the first piece of it. And then coming to the second piece of it, who all can accept, like what we have discussed, private, public and eligible, and when it becomes an eligible company. So this gets covered. And then as a last but one round, as a last round, what are the maximum percentages what one can accept? So, and then what the special points with regard to other ones. So now first I will go to the maximum permitted the deposits, who can accept from whom and what is the maximum permitted. This chart and the chart that I'm going to show you, if you remember these two charts, you are good enough to get your 5 marks. So, because you don't have to simply waste on reading the conditions and all that, the structure of it is not very clear for students. That may be clear for practical, it's a Companies Act, it is more for practical application. But as a student, you remember these charts. This chart plus the chart that follows, you can answer even the number related questions out of this chapter in a comfortable way. Now, what is the maximum I can accept deposits from members and all? Now, if you look at this, that would depend upon, are you a private company or are you a public company? If you are a private company, and then a startup up to 10 years, they can accept any amount from members. I'm talking about from members. Any amount you can accept from members. Or if you are a private company, satisfying 3 conditions, that is, you shouldn't be the subsidiary of this, any other company, and then borrower should not be twice your capital and all this kind of stuff, then without any limit. But otherwise, maximum a private company can accept from members is 100% of 3 variables. In this entire chapter, all percentages are applied only to these variables: paid up capital and securities premium and free reserves, 100%. But public company, then how much you can accept from members, then it depends on this. If you are a specified IFSC public company, then up to 100%, or if you are an eligible company, up to 10%. If you are any other company other than these two, then up to 35% of it. Now, this also will not give you the required command that you need to get it. I will take you to this chart. This is the one which you must read before going to the exam, and most of the times your questions will be out of this itself. Now, what this says is combination of how much you can accept from members and how much you can accept from public. Once you are an eligible company, I'll pass here and I will go one step backwards. When a company will be called as an eligible company, three criterias. Two what we have, but we are adding one more. First, it must be a public company, and then two criterias: net worth and turnover. What are the numbers? 100 crore and 500 crore. All the conditions are any one condition. Any one condition you satisfy, you become. So, who can accept from whom? Now, if you are an eligible company, maximum you can accept from members is 10% and from public 25%. So, in all, 35% of three variables always: paid up capital, securities premium, and free reserves. That is what you can accept. If you are a private company, you can accept 100%, but only from members. If your members don't have the money, then you can't do anything. So, only from members you can accept. From public, obviously, private company cannot accept. But if you are a government company, maximum you can accept is again 35%. Then what's the difference between eligible company and government company? Both of them are 35%. Diversified. That is, if you are an eligible company, 10% from members and 25% from the public. But if you are a government company, there is no such bifurcation. In all put together, it's an overall limit. So, overall limit is 35%. So, all that 35% you can accept from members, or all the 35% you can accept from public. So, this chart, if you are good with, then you are done with that. So, to protect you, even if you have, I suggest as a faculty, I expect you to read every line of it. But since that is not possible and you have limitations in reading it, what all you must read in this chapter? First is the definition of deposit. Now, when I am learning, that's where, though it is a tough chapter and very confusing chapter, close your eyes. Now, try to think of it. What is that we have revised? Now, we revised definition of deposit and the exemptions. Now, you tell me, what is the definition of a deposit? Any money received in which form? Deposit, loan, or any other form. It is a deposit unless it is exempted. Now, under exempted category, now list me all the 5 exceptions that we talked about. We'll ignore that generic one. Central government, foreign governments, and banks and financials, you ignore all of them. The specific cases. One is the share application. Now, why I'm saying that is, take somewhere as a revision notes. Because whenever, now it is all right. You have all the time, you can revise everything. But one day before the exam, you may not be able to read it. And the more you read, the more confusion will add up. That's why on the day before exam, or to put it more simply, on the morning of that exam. So when you want to touch this tough chapters and go for it, in the definition of chapters, what are the 5 points I should remember? One is the share application and call money. Now, calls in advance. Now you tell me, when will it become a deposit? Not refunded within 75 days of it. That is the share application money fast. Then the second one, directors. Now, the directors, when it will become a deposit? If they are taking it as a loan and giving it to you, if they are taking it as a deposit and giving it to you. But when it will not become a deposit? Other sources. Example of other sources, gifts from relatives and all that, or his salaries, his personal income. Like, just as a narration, a director, say, imagine I am the director in a company. My company is into deep problems. Now, they don't have money to pay salaries and the employees are fighting with the management and all that. Now, what I did is, because I am the director, I want to help the company. I sold my building, what I am having, because I can take back from the company at a later stage. So, I don't have money in the bank. So, I sold my building. With that money, I gave that money to the company. Deposit or not a deposit? So this is where I want you to get little analytical. Otherwise, you read what he is giving is all right. But I don't want you to become example for your next juniors and all that. So how you have to remember is, as long as it is the personal source for the director, then it is not a deposit. But he is acting only as a dummy guy, taking from there and giving it to you because you are not allowed to take it. If the director is being used as a dummy character in between, then it will become a deposit. That is, he is taking it as a loan and giving, he is taking it as a deposit and giving, it becomes a deposit. But if he is giving from many other sources, like selling his own property, from his salary income, from his personal savings, from his mother's personal gifts and all that, or money given to him by his own children, any other things, then it will not be a deposit. So that's how we have to remember. So going back to it, exemptions to deposit. 5 major categories, critical categories you must read. One is the share application, and second one is the directors. The third one is employees. Now employees, what are the 2 points? Annual salary, non-interest bearing. Then the fourth point, promoters. So promoters, 3 conditions. Promoter had given because it is required as a margin loan, margin money requirement, and promoter himself had given that money from his sources or from his relatives. And the third point is the loan is repaid. This money is paid back before the loan is repaid. That's all. So all 3 conditions will have to be satisfied. And the fifth one is a startup company. Now startup company, quickly tell me the conditions. More than 25 lakhs, single tranche, repayment more than 10 years or less than 10 years? Less than 10 years, and convertible note. All conditions are anyone? All conditions. If you are good with this 5 exemptions, 90% chances are there you will get it. And then you have to come at which company can accept from whom. Now, you tell me, which companies are allowed to accept from members? All 3 companies. Which companies can accept from members? From members, all 3 companies. Which companies can accept from public? Only eligible company. Now, eligible company, there are 3 conditions. First, it must be a public company, net worth and turnover. What are the limits? 100 crore and 500. All the conditions are anyone. Any one condition out of that, it becomes an eligible company. Then you can accept. Now, once you are an eligible company, what is the maximum deposit that you can accept? Overall 35%, and sublimit is from members 10%, from public 25%. Then how does it differ from a government company? Maximum is same, but it is interchangeable. So 35% you can accept from members, or 35% you can accept from public. So, and if you are a private company, what is the maximum? 100%, but that 100% should be from members. So now if I ask you randomly, who can accept maximum from members? Private company can accept maximum from members. Next to private company, who else can accept? Government company. And after government company, eligible company will come. So, how from members? What from maximum to minimum? What is the maximum percentage that from members can be accepted? 100%, 35%, and 10%. 100% by whom? Private companies. 35% is by government companies. 10% is by eligible companies. That's how you have to slowly get a comfort of it. The more and more you analyze, the more and more simple it starts looking. Otherwise, my suggestion is focus on these charts. The more you read onto the text, the more confusion will start adding onto it. So that's how you can start getting grip on this one. Then there are certain miscellaneous points you also need to remember. Now I will get to those points of it. Then whenever I am accepting deposits, whichever 35%, because that's why I'm discussing at the last. I can accept 100% for few cases, 10% for few cases and all this. That's all right. But whatever the deposits that I am accepting, how long, when I should repay? So what is the maximum period I should repay these? So this is similar to your redemption of preference shares. So where you say 20 years and all this kind of stuff. Likewise, debentures and all this kind of stuff. Likewise, what is the, now I will put the direct question. What is the maximum period within which you have to repay? 36 months. And what is the minimum period you have to retain this? Is a 6 months. So understand this one clearly. Whenever I am accepting deposits from the public or members, even within that allowed limits, the minimum period a company is taking must be 6 months, and the maximum period is 36 months. So after 36 months, you can renew it, but within beyond 36 months, it is not permitted. It is similar to 20% for your redeemable preference shares and all this kind of stuff. So 36 months. But can I accept less than 6 months? The answer is yes, but there is a sublimit. So that is the maximum I can accept less than 6 months. That is, but more than 3 months. Less than 3 months, not at all permitted. So 3 months to 6 months, maximum I can accept is 10% of paid up capital, free reserves, and security deposits. Securities premium. Out of all these three, 10% is what maximum I can accept it. So now, let us get a hold on this. What should be my tenure of payment of deposits? 6 months to 36 months. Can I accept more than 36 months? No. So I have to repay them within 36 months. So, but can I accept less than 6 months? Yes. But up to what month? 3 months. So 3 to 6 months, what is the maximum I can accept? 10% of 3 variables. So these variables you don't have to get confused. In the entire chapter, once you remember the percentages, these variables are the same. Paid up capital, securities premium, and free reserves. That's all. So this is what is the maximum points. So one side questions you can ask. Can a company accept demand deposits? Say demand deposits are almost like your savings account in a bank. Now you deposited in your account, but you can withdraw anytime. Whenever you want, it is your will and wish. So today you want 10,000, you can draw 10,000. That is demand deposit. Likewise, can a company accept money from somebody where he can withdraw whenever he wants? That's not accepted, because when you are taking that money, you would have spent it for some purpose. When he is asking how he will repay. So that's why so to cut it short, demand deposits are not permitted to be accepted at all. So this is the overall summary. Now, since this is a complicated chapter, I prefer to revise one for the last time, the entire chapter, and then we will go to the other chapters. Now, tell me quickly, definition of deposit. What do I mean by deposit? Any amount you received in 3 forms. Deposit, loan, or any other form. Now, unless it is exempted. In the exempted, I have 5 specific exemptions which I must read. First one is the share application. Quickly. When share application money, one-liner, after 75 days. Then my second question comes from directors. When it is not treated, or when money from directors is treated as a deposit, taking as a loan and giving, taking as a deposit and giving. But when it will not be treated as a deposit, any other sources. Example of any other sources? Giving as a gift or sale of his own property, his salaries, his own savings, anything from his bank account, all that will become his personal money. It will not be a deposit. Then from promoter or from employees, coming in the order. 2 points are important. Up to annual salary and non-interest bearing. So if it is interest bearing, it will become a deposit. So these are the exemptions. Then promoters, 3 conditions. It must be a margin money requirement. Promoter himself or his relative himself have given, and the loan is repaid before that. This money is refunded before the loan is repaid. So these are the 3 conditions. And the last one is the startup company. Startup company, 4 conditions. What are the 4 conditions for startup company? More than 25 lakhs. Single tranche, and repayment of less than 10 years, and convertible note. If all conditions are satisfied, it's not a deposit. Otherwise, it will become a deposit. That's all. Now, what are the 3 conditions for an eligible company? Public company, net worth and turnover. Net worth and turnover, what are the limits? 100 crore and 500 crore. Both the limits are any one limit. Now, from whom this eligible company can accept? From directors, from members, and from public. What is the maximum they can accept? 35%. But how the split works? 10% from members, 25% from the public. That's how the split works. Then which company can accept without the split? government company without the split. Now, private company can accept up to 100%, but catch is only from the members. From public, you are not supposed to touch it. That's all. As long as you are good with that. Now, with this knowledge, you see any sum, whatever they are asking, you won't find it very difficult. You will find it very easy to solve. Now, I'll just note it down question. That's why I'm looking at it. So that I want to show you, this is same 2026 January. I'm showing this because I want you to get a feel that you are able to solve even the updated ones. Now, look at this question for 5 marks. Now, I want you to spend a while, look at it, see whether you are able to get it. Because this is the latest question. If you can answer this, then you are good enough. I will also start reading. Say paid up share capital 20, free reserves 8, securities premium 2. Why did you give all this? Because for all percentages, we have to add all this. So now what is the summation of all this? 30 crore. So that is what is your one line limit for all percentages. Then existing deposits from members, 2 crore. And existing deposits from public. So excluding members, 5 crore. So they've already accepted 2 crore and 5 crore from the members and all. Now the company now proposes to accept further deposits during the year 24-25. Now 3 crore from its members, 2 crore from persons other than members, general public. But can they accept from general public? First point, forget about the limit. Can they accept? Yes. Why do you say so? Eligible company. Now who said it's an eligible company? He himself has given in the question. Otherwise, you have to look at it. What is the net worth? What is the turnover? You should have, but there is no need now. So it's an eligible. Now the question is simple. As an eligible company, what is the maximum that you can accept? I want you to 35%. But that 35% split between 10% and 25%. Now that 10%, 25%, I have to take on what amount? Total 3 variables. What is the sum of my 3 variables here? 30 crore. So 10% of 30 crore members. 3 crore maximum I can accept from members. Now one small logic. Is that 3 crore? How does that 10% apply? Every time or at any point of time? Any point of time. So that is, it's not that whenever you want to take, you can take up to 10%. Then people will take 10 times 10%, it will become 100%. So apply that logic. That's why at any given point of time, my deposits from members should not exceed 10%. So my 10% of my 30 crore is 3 crore. But I have already accepted 2 crore. So how much more I can accept? 1 crore. But how much they wanted to accept? 3 crore. Now, is it permitted? Not permitted. Just that you have to draw tables, but at least get the content of it. If it is a regular class, I would have opened the table, made you do that, but at least get that logic behind it. Now, second one, from public. Now, you tell me. How much they can accept from public? 25%. 25% of 30. How much that would be? 7.5. How much they are already having? 5 crore. So how much more they can accept? 2.5. Now how much they wanted to accept? 2 crore. So is it permitted? Yes, permitted. Just that you have to draw the numbers and do it. So that's why I'm saying don't get scared of this chapter. But unfortunately, this is an important chapter. So, and you cannot think of skipping it at all. And be it in the form of MCQs or be it in the form of short questions, 5 to 10 marks are going to chase you. So that is why you must read this chapter. Only thing, as I said, definition with 5 conditions and then what is the maximum it is. If you are good with these 2 points and pad up with little more, like one is what is the maximum repayable limit that I need to have. So now you tell me, whenever I'm accepting deposits, what is the minimum and what is the maximum? 6 months and 36 months. Now, can I go beyond 36 months? No. Can I come less than 6 months? Yes. Up till what month I can come? 3 months. So what is the maximum? 10% of 3 variables is what I can do. Now, I will ask you a question. Can an eligible company. Now I will tell you. Eligible company, maximum how much they can accept from members? 10%. Now eligible company want to accept members from public, want to accept deposits from members which are repayable in 4 months. What is the maximum they can do it? So what I'm trying to say is, I'll break that into two. As an eligible company, how much you can accept from members? 10%. Now this is like, say, in our maths we used to say, take like equation 1. Now the second one, when I am accepting deposits only for 4 months, then what is the maximum I can accept? 10%. Then here I have taken 10, then here I have taken 10. Then is it 10% of this 10%? Getting it? So you are lucky that you are not thinking so much. That's why it is life is looking cool. But otherwise, you don't have to analyze. There is nothing. Only we are trying to confuse ourselves. But the point is simple. These two are two independent equations. It is not subject to one-on-one and all that. So if the repayment period is anywhere between 4 months to 3 months to 6 months, then maximum I can accept is 10%. Now, but in any case, for an eligible company, I can accept only 10%. So, an eligible company, whether you call it 4 months or you call it 14 months, it will not make any difference. But for which company it will make difference? Think logically and tell me. For private companies, it will make a difference. If you are a private company, and if I want to accept 4 months, which I want to repay in 4 months, then I can accept only 10%. But if I want to repay in 20 months, then I have to 100% I can go. So that way, the more you analyze, this is just an example. Don't overread this chapter. The more you read, the more confusion it will arise. So restrict your boundaries at a priority 1 to this limited boundaries, like what we have discussed. And depending on your comfort, depending on your availability, slowly start getting deeper and deeper to the extent you can go. But whatever we discussed in the class today, you must have the control on it, because that is what is being asked in the exams for now. Now, one last thing he is asking is, whenever I am taking this in joint names, what is the maximum people I can include in the joint names? 3 members. That's all. That is one small MCQ which is falling in it. That is, can a deposit be taken in joint names? Like how the shares can be joint shareholders, can deposit holders also can be joint? The answer is yes. So, but how many people can collectively joint? It is, maximum is 3 people. So that's all. With that, this chapter is over. Now, having covered 2 chapters, go for a quick break of 5 minutes. After that, we will try to cover this remaining chapters. So just take a small break of 5 minutes. Okay. So let's start with this chapter 7. Now, the reason for picking up this chapter 7 is, this, along with our acceptance of deposit and registration of charges, is amounting to almost 25% of it. So, having covered those two, if we can cover this also in depth, then at least 25% is clearly complete with regard to this. Then, but this is fairly a simple one, just that we have to retouch that sensitive points and then be comfortable. And talking from the importance of it, it is a must to read chapter, because this comes under this. Then the meetings, this general meetings are of 2 types, AGM and EGM. Now, we know that AGM is mandatory and EGM is optional for you. Now, you tell me, AGM, quickly, since you all are just days away from exams, what is the due date for AGM? Now, that would depend on, is it the first AGM or is it the subsequent AGM? If it is first AGM, the earliest of 2 timelines, that is 9 months from the date of financials or 18 months from the date of incorporation, whichever is early. If it is subsequent AGM, then 3 things: 6 months from the closure of the financial year, and interval between 2 AGM shall not be more than 15 months, and 1 AGM must be held in every calendar year. So, and for talking about the extension, extension will be given only for subsequent AGMs, but not for first AGMs. We discussed in our regular classes why there is no extension for first AGM. Because this extension of 3 months is already being built in this timeline. So 6 months has become 9 months, and then 15 has become 18. So it's already loaded. That's why it is not there. So extension can be possible only for subsequent AGM, that too for 3 months maximum. That can be given by ROC. He is asking questions. Like say, for example, this 4 marks, simple questions. And examine the validity of the statements. The first AGM of the company will have to be held or shall be held within 6 months from the date of closing. Before that, now let's revise. First AGM, now you tell me, what are the due dates within when I have to hold my first AGM? 9 months or 18 months? For subsequent AGM, 3 timelines. 6 months, 15 months and calendar year. So whichever is earlier, that is when I will have it. So first AGM will need not be held within 6 months. The time limit given is 9 months from it. Then the second one, the registrar for any special reason extend the timeline within which first AGM shall be held. Extension is permitted for which AGM? Subsequent AGM, but not for the first one. And subsequent AGM should be held within 6 months from the closure of the year. Yes. So, and the third one, there shall be a maximum interval of 15 months between the 2 AGMs. So, yes. So, this is how you get your questions to it. Now, let us go back. So, due dates and all that we have discussed. Then, time, day and place. Now, I'll go back to the same chart that we have taken in the regular classes. Now, when my AGM should happen, my AGM from the time perspective, AGM should always happen in the business hours. But exemption to that is any AGM commenced during business hours can continue beyond business hours. But no AGM, no point can start, no AGM can commence after business hours. Then on which day I can have my AGM? Any day except national holiday. So, but when I can have AGM even on a national holiday, if it is declared as a sudden holiday. So, then I can have it. Then first 2 are not, to be honest, he's not testing you much on this, but he's testing you more on the place of AGM. Now, this place of AGM, take 5 stars to it, and even when you read it, because the latest trend of questions, he's focusing more on the place concept of it. This time and day, it's all over. There are traditional questions, that is over. Now, where I should have my AGM? Now, any place in the city or town of registered office. But there are 3 exceptions for it. Say, I'll combine these 2 charts and tell you, because it is important. And here, because there are certain amendments and extra clarifications given by MCA, is asking. This is the latest trend of question. So I repeat, where should I have my general meeting? General meeting, ideally, I should have it at the same place in city or town where I'm having registered office. But the question can come, if my registered office is a too small area, or it's happened like for SEZ units and all, their registered office may be in a village, so in a backward area. Now that place is not sufficient, and for members to come, the transport and all that, that is where the members have requested, can I have my AGMs anywhere else? So that is what they have asked. Can I have my AGMs anywhere else in India other than my registered office? But for that, combining and summarizing all that points, you can have anywhere, but not for everyone, but for 3 types of companies. One is unlisted companies, second government companies, and third one Section 8 companies. But even for these people, you need not have it at the registered office. You can have it at any place, but it must be only in India. That's all. So then, even for these 3 companies, to have it within India, you need to satisfy these conditions. If you are an unlisted company, then all members must agree in writing. Then only you can have your AGM outside your registered office. But if you are a government company, central government will decide. If you are a Section 8 company, the board of directors will decide. So, but now, this point is the additional point which you should remember, which is where he is asking questions on. Otherwise, this point also, to my knowledge, it is also got exhausted, because same points continuing, there is nothing new. The same points are continuing earlier and now, so it's nothing. The new points that are added are these points. That is, and this one liner, these 2 points will make you get 5 marks. So the weightage of it is just building up a big case study, but the bottom line is these 2 small points and just putting to the top. Now an EGM of a company must be held at a place within India. That is the general rule. Exception to that is, if a company is a wholly owned subsidiary of a company incorporated outside India, then EGM can be held outside India. Now, listen carefully. Now, who can have, where should my EGMs? EGM should be held within India. Now, but only one condition, you can have EGMs outside India. For whom, if you are a company and you happen to be wholly owned subsidiary of a company outside India. Again, which company is it talking about? So, is it for Indian company or a foreign company? Can I simply say exception is for foreign companies? No. So, he is not talking about foreign companies. Foreign companies, anyway, they will follow foreign companies' laws. So, they will not have their EGM in India, because when they are incorporated outside India, they will have their EGMs outside India only. You are not governed. Foreign companies, that we will discuss in our next chapter. Foreign companies, not entire Companies Act is applicable. Only limited concepts are applicable to them. So, therefore, foreign companies is not the point. Then, for which companies is it talking about? Indian companies only, but who happen to be wholly owned subsidiary of a foreign company incorporated outside India. Then, though you are an Indian company, you can have your EGM outside India. The logic here is simple. Because though you are an Indian company, who are your members here? Your member is a foreigner. So, it is a company incorporated outside India. Just because you are an Indian company, I am trying to build up the logic, because this is the only special point you have to learn. Otherwise, this chapter is also like mostly you are comfortable, just that you have to refresh. So, I am holding here for some time. What is though you are an Indian company, but since your parent, that is your shareholder, is only one person, that too he happened to be a foreigner. Now, if at all you have to have EGM in India only, if the government is stubborn, then you are expecting that foreign company to send somebody all the time to India. Then 2-3 years they will send. But in the cost cutting mode, then they get fed up and say that no, in India rules are too tough. Now every year you have to travel, and for business you have to travel. And though there is no business need, just for attending meeting you have to travel. So they may get fed up. So since the India is in the mood of ease of doing business, they want to give as much as comfort to the investors. That's why they said, if you happen to have only one member, that to a foreigner, then have it outside India. So it is a relaxation given to this companies. So if you sum it up, the combining all this, where should I have my EGM? So for all other companies, simple thumb rule is you must have it only at the place of your registered office. That's all. But 3 companies have been given exemption, the slight relaxation. You can have EGM anywhere outside your registered office, but it also must be in India. First level of relaxation. Who are those companies? Unlisted companies, government companies, and Section 8 companies. What is the condition for unlisted company? All members should agree. What is the condition for government company? Central government will decide. And who will decide for Section 8 company? Board of Directors will decide. So this is the relaxation one. You can have it outside your registered office, but within India. And the second relaxation is, forget about outside registered office. You can have even outside India as well. So then what is that company? Who can have one liner, simple one liner you should remember. Which company can have EGM outside India? Only Indian company, which is a wholly owned subsidiary of a foreign company, company incorporated outside India. Then only you can have your EGMs outside India. Otherwise, rest all you should have it in India. Now, I will ask you a question. Indian subsidiary, that is it like Indian, what is the exemption given? Indian subsidiary of a foreign parent, or Indian parent and foreign subsidiary? Getting it? Why I am asking? Otherwise, it's okay. I shout, you shout, all that are fine. But once you stop and try to analyze, is this Indian company a holding company or a parent company, you get a doubt. Now, for whom this exemption is given? In this case, I'll put it to the top. In this, is Indian company a holding company or a parent subsidiary company? Look at it and tell me. In this example, where relaxation is given, is this company Indian company? Is it the holding company or is it the subsidiary company? Subsidiary company. So, if Indian company is having a subsidiary which is abroad, getting it? So, that is, company is, I think I've drafted here for your comfort, for normal Indian company. Otherwise, I keep talking, you keep answering, but again, you don't know what you've answered. So, because this is confusing. And mind you, I'm not simply pulling it for the sake of discussion. This question is asked for 5 marks by giving these two, say, you know that. So, since you have read past questions and all, summarizing this. For a normal company, Indian parent is in India, subsidiary is in India. Then you must have EGM in India. Other way of learning this in a simple way. Now, Indian wholly owned subsidiary of a foreign company, meaning parent is outside India and subsidiary is in India. Then you can have EGM outside India. That is permitted. Then the third scenario, parent company is in India, like our Wipro, Infosys, these kind of companies, but they have foreign subsidiaries. Your subsidiary is outside India. Then where that subsidiary should have the EGM, they are governed by foreign laws. That is, India, in this case, EGM, it must happen in India. But EGM of this foreign company, it is not, it is happened to be a subsidiary of Indian parent, that's all. But like subsidiary of Infosys. Now, do they have to come all the way to India and have EGM? Doesn't make any sense. So, they are governed by their foreign laws. So, they can have outside India. So, whether outside India or in that we don't know. They are basically governed by foreign laws. This is governed by Indian law, but you can have it outside India. So, that is what is the exception. So, to summarize, if you are an Indian and you are an Indian wholly owned subsidiary of a foreign company, then you are, because you are an Indian company, you are governed by Indian Companies Act, but nevertheless you are being given relaxation. But you are a company incorporated outside India and happen to be subsidiary of India, then you are not incorporated in India. You may be subsidiary, but you are not a company incorporated. You can anyway follow your own company's laws, so foreign laws. This is the summary that you should, and this summary will help you crack your 5 marks in the event of questions on this. Then I'm going back to this one. So this is the time, place and this one. Then what happens if AGM or EGM is not conducted within the time? Then NCLT can call, or they can direct to call the company to conduct AGMs and all. What are the sections? If EGM is not conducted, then under section 97, NCLT will call. And if EGM is not conducted, then under section 98, NCLT can call. So, this is, what is that small point? So, I am ignoring. Now, EGM. This is important. He is asking in it. Now, you tell me first. Is conducting EGM a mandatory or optional? Optional. So, but who can call EGM? So, whenever you wanted to call, who can call EGM? EGM can be called by the board of directors only. Then when the EGMs will be called, either the board themselves want it, or when it is requested by the members. So, in your exam, this point is what is trusting your understanding of it. So, you know that I'm not really getting into too many previous year questions that will eat up our time. So, based on the request of members. But how many members should request? 1/10. If they have the capital, 1/10 of capital. If they don't have the capital, 1/10 of voting right. So, if they have exactly 10%, more than 10%, they can request EGM. But if they have exactly 10%, they can. So, 10 or more, they can call for EGM. So, now, you tell me, what are the time limits when the members are calling? What are the time limits within which I should conduct my EGM? There are 3 numbers that you have to remember. 21 days, 45 days and 3 months. Now, 21 days is for calling the meeting. Whenever you request, then within 21 days from the date of such request, you should call for the meeting, meaning you have to issue the notice. And then what is the time you should actually conduct the meeting? Within 45 days. So, and what happens if 45 days it is not happening? Then members are going to conduct within 3 months. So, within 3 months from the date of requisition. So, now I will summarize this. Now, you tell me. Just answer this quickly. Is conducting EGM optional or mandatory? Optional. But whenever the company want, now who will call EGMs? Board of Directors. But can members also call EGM? Yes. But how many members should request? 110. 110 of what? Either paid up capital or voting rights. Now, whenever they are, can the members call themselves? They are more than 10%. Can the members call themselves? Option 1 is what? They have to request the directors to call for it. But what is the time given for directors to conduct the meeting? 21 days for calling the meeting and 45 days to have the meeting. But if 45 days meeting is not conducted, then members can call themselves. But when members are conducting the meeting themselves, they may be incurring some expenses. Because since members are only calling, which means directors are not supporting their food expenses and all this audio, video and all this, then who will have to bear that expense? Defaulting director. So that money will be reimbursed by the company by deducting it from the defaulting director's personal remuneration. So that is the personal the limitation for the directors. So these are the big number of questions that I was talking about. Now let's move on. So place of and all that we talked about. Then prerequisites of a meeting. So prerequisites of a meeting, there are prerequisites at 3 stages: before the meeting, during the meeting and post the meeting. Why do we call prerequisites? Without satisfying this, meeting cannot be valid. So now first one is a notice. Now you tell me quickly, since it is a rapid revision, what is the length of notice? 21 clear days. When I say clear days, what am I excluding? Date of notice and the date of meeting I am excluding. In between I should have 21 days. But which company can have lesser number of days? Section 8 company. Their notice period is 14 days. That's all. Now, explanatory statement, that is, I'll come logically here. So first take the notice. Then whom all I should send notice? Every member, every director and auditor. But every member, but what happens member is not alive? Legal representative. But what happens if the member is insolvent? The assignee. So, but every member I have to send. But do I have to send it to preference shareholders? Do I have to send to, because when I said member, preference shareholder is also a member. So the logic is, whom I have to send the notice? To every member who is entitled to attend and vote in the meeting, to him you have to send. Then the logic goes by, when the preference shareholders will get a voting right, when the dividends are not paid or the matter relates to them or the matter relates to winding up. So that extended discussion will come into picture. So to every member I have to do that. Then what about in the case of joint shareholders? Do I have to send notice to both the members or any one of them? Whosoever name appears first in the register, I will send the notice to him. That is, notice will not be sent to both the joint shareholders. Not necessary. So, then what about beneficial owners? That is, owners are of 2 types, registered owners and beneficial owners. Do I have to send notice to the beneficial owners? No. Beneficial owners, notice will not be sent. Notice will be given only to the registered owners. That is, in our minor parent case, minor is my actual member, but I have to send notice only to the minor. I need not send to the parent. But what minor can do? That doesn't bother. You will not be communicating to everyone. You send only to the members whose our names are registered in it. That's all. So that is what it is. But can I send notice, or will I have to send notice to anybody other than this? The private company can add it in their articles. So any persons other than this, then when it becomes mandatory for them. Then Non-receipt of notice, if it is accidental, it is all right. But if it is intentional, even one person not receiving it, it will be deemed as an invalid. Now, notice, length of the notice, 14 clear days and 21 clear days and all, we talked about is, what is this 21 days or 21 clear days? Meaning the date of notice and date of meeting are excluded. In between, I should have this 21 days. And on this, you have several questions being asked on this one. But shorter notice. Can I have a shorter notice? That is, there is no time to give 21 days and all that. Can I go for a shorter notice? The answer is yes. How many people will have to agree? 95% of the members will have to agree in writing. If 95% of the members agree in writing, I can even go for a shorter notice and all that. Then, can I give this notice through advertisement? So, issuing advertisement through notice as a shortcut is not valid. But with regard to two types of shareholders, I have to issue notice through advertisement. Who are all that two members? Who don't have the address in India or who have not provided the address in India. So with regard to those two shareholders, since I have to send to every member but they have not given address, then can I ignore them? No, you cannot ignore. If they have given address, send to their address. But if they have not given address, then I have to advertise. That's all. I have to advertise in the paper. Then whenever I am advertising, then when the date of notice is deemed, whenever it is published, that is the date when it is deemed as issued and all this kind of stuff. So, and when the letter is posted, when the notice is posted, then it is deemed to have been sent only after 48 hours of it. Now, let's summarize this notice quickly. Now, you tell me, what is the length of notice? 21 clear days. But for whom the period is different? Section 8 companies. Then what about adjourned meeting? Is notice required for adjourned meeting? I'm slightly jumping it, but it is also on the notice, so I'm taking liberty here. Yes, notice for adjourned meeting is also required. But how many days notice is required for adjourned meeting? 3 days notice. So, whenever we are talking of the length of the notice, 3 different dates we'll have to keep in mind. 21 days, 21 clear days, 14 clear days, and 3 days. So, not 3 clear days, 3 days. So, this 21, 14 you are clear, 3 is for adjourned meeting. That is what is this one. Then can I go for a shorter notice? Yes. When the shorter notice will be valid? 95% of them will have to give it in writing. So, that is what is this points on this. Then, serving notice through electronic mode, it is a, considering the time I am skipping it, that is, can notice be sent by email? The answer is yes. So, the remaining points and all are small points. So, I am not really. And what happens? The company had sent the email, but the shareholder had not received. Is the company responsible for it? No. So, company's responsibility is only in transmitting the email. Shareholder not receiving it is his problem. Company is not bothered about it. So, that is that important point. Other points I am skipping. Now, explanatory statement. For this, we have to first discuss about ordinary business and special business and then come to it. Now, businesses are of two types, ordinary business and special business. Now, ordinary business, there are 4 points. What are that 4 points? Consideration of financials, declaration of dividend, appointment of directors, and appointment of auditors. When these are discussed in the AGM, it becomes ordinary business. Rest all cases, it is an special business. Why do we divide them between ordinary business and special business? Now, for this purpose, if it is ordinary business, it requires ordinary notice, and if it is special business, it requires special notice. Now, what do I mean by special notice? Notice plus explanatory statement. So, indirectly, to cut it short, when I have to send explanatory statement? For special business. Now, which meeting I can have special business? In AGM or EGM? In both the cases. In exceptions can be there in, that is in AGM, can I say all business in AGM are special business? No. Can I say all business in EGM are special business? Yes. So, to cut it short, what are the 4 businesses that are considered ordinary? Consideration of financials including audit report, declaration of dividend, and then 2 appointments. Appointment of directors, appointment of auditors. Now, that's all. Anything other than that, is a special business and you require. Now I will ask you some questions. Do I have to give explanatory statement for sweat equity? Yes, because sweat equity shares is not an ordinary business. Once it is a special business, explanatory note is required. Likewise, any such cases, this explanatory statement would become a requirement. That is what is this point. Then come to the quorum of it. Now, when I say quorum, it is the minimum number. Now, you tell me, what is the minimum number? How many members should attend a meeting to say that I have a valid quorum? It would depend on the private company and the public company. For private company, how many people should minimum attend? 2 people, 2 members attending is sufficient. But for a public company, it would depend on the number of members. What are the 3 slabs that we have? Up to 1,000, 1,000 to 5,000 and more than 5,000. And what is the quorum here? 5, 15 and 30. Is it the minimum or maximum? Minimum. So minimum is this many number should appear. Then what happens, since it is a simple concept, you are all familiar, I'm just getting onto the revision mode. Now, what is the time given for the quorum to be present in a meeting? Half an hour, first half an hour. What happens if quorum is not there? Adjourn. Adjourn to what date? Same day, time, place next week or any other date. Now, what happens in the adjourned meeting also? There is no quorum. Meeting is cancelled or meeting will continue? Meeting will continue. But which meeting is cancelled for lack of quorum? Members, that is the meeting, adjourned meeting requested by the members. So, to put it short, what happens when there is no quorum? That would depend on this one. Now, is it original meeting or is it adjourned meeting? If it is original meeting, again, is it a meeting called by the board of directors or is it requested by the members? If it is by the directors, then any of this. If it is requested by the members, then it is straight away cancelled. This cancelled one is what you need to specifically remember. He is asking this. And adjourned meeting, there is no quorum, then members present shall form the quorum. Now, one small question. What is the power of my articles? Can it increase it or can it decrease it? Quorum. Quorum. Because I said quorum is this as per the Companies Act. Can my articles increase it or decrease it? Increase it. Because what is set in this Companies Act is the minimum number. So like up to 1,000, my articles can say that I need 6 people. So, but my articles cannot say it requires 4 people. So this is what is this quorum requirement. Now, and while counting this quorum, whom all we exclude proxies. We will exclude now, and thus exclude proxies, and then but 2 people we will consider. Representatives of body corporate and representatives of governor. So governor or the president or governor we will consider. Then we have certain additional points. What happens if 2 or more body corporates attending the meeting? Then they are counted as that many in number. So these points you are very similar and you are familiar as well. And what happens if a person is attending in more than one capacity, that is one as a representative of a company, one as a shareholder himself, then he will be counted as that many number and all. Then you tell me, let me see how much you remember. What about joint shareholders? Will they be counted as only one of them is attending? Then will they be counted or will they not be counted? Counted. But exception is, because that is a standard traditional question, may not be asking in this current times. That is, I'll put this here. In the case of joint shareholders, any one of them attending is sufficient enough. That will be treated as a quorum. Both members need not come. Any one of them is attending. But what if both of them are attending? So both of them are attending, generally also will be treated as one member. But in exceptional case, where in this Australian case, it is counted as 2 members personally present. Except in this case, it is always treated as one member attending and all that. Then what if my actual members are falling less than the requirement? This can happen in abnormal situations. Then if all the members are attending the meeting, then quorum is not valid. So it is not a requirement. Then proxies. Now I will ask you random questions. Now who can appoint a proxy? Member. Which member? Can every member appoint a proxy? No, not all members can appoint a proxy. A member who is entitled to attend and vote, so he only can appoint a proxy. Now, what rights proxies are having? What rights proxies are not having? Can proxy vote? Or I'll put that simple question first. Can proxy speak in the meeting? No, he don't have a right to speak. But then will he have a right to vote? Only on poll method. On which method he don't have? On raising of hands and all those he don't have. So only on a poll method proxy will be allowed to vote. Otherwise, except that poll method, he will not have that right to do it. Then what is the maximum for a proxy? That is, with regard to the maximum, 10% of 10% of holding. That is, what I am asking is, or I'll put that, reframe that question and put in a simple way. Can all members appoint a single person as a proxy? No. So, a proxy can represent maximum of 10% of the members. But what if a single member is holding more than 10% of shares? Can he appoint proxies, or will he have to split and appoint two different proxies? You don't have to split. Even if though maximum is 10%, but if a single member is having more than 10%, he can still appoint a proxy. But what is the condition? There is one condition here. That is, if a shareholder is having 15% of votes. Now, can he appoint a proxy? Because proxy maximum percentage should not exceed 10%. That's a logic. But one shareholder himself is having 15%. Can he appoint a proxy? The answer is yes, he can appoint a proxy, but the condition there is such person should not be appointed as a proxy by any other person. So that is what is that condition. So that is what we have discussed in it. Then what about Section 8 companies? Can they appoint proxies? Yes, they can appoint, but the proxy should also be a member. But for a normal company, proxy need not be a member. But for Section 8, he must be he must be a member and all that. Then, important question. These are all the simple questions, but this chapter is, though these are traditional, age-old provisions, that is, whatever you are reading now, is what even I read some 30 years ago when I was writing my exam. So, no change in that. So, it's all dead and dusted. But still, he will keep asking because these are practically relevant, but not as a regular relevant. And that's why the more important concepts in this is about significant, beneficial owner and significant beneficial owner. That is where you got more chances of. But this also, since he keeps asking, let's cover this and complete. Now, what is the time limit given for submitting proxy forms? 48 hours. Now, what the company can do? Can they reduce that 48 hours or can they increase 48 hours? So, company can reduce this 48 hours, but company cannot insist the members to communicate to them more than beyond 48 hours. So, that is what is. So, this 48 hours, that is what we learn it. What if their articles contain more than 48 hours, then it will be read as if 48 hours are written to it. So, indirectly, companies' powers are in reducing this 48 hours requirement, but they cannot increase it. Then, inspection. Can a member inspect the proxy forms? The answer is yes. Now, with regard to inspection, there are three different timelines. Now, just I will open for convenience. Just a second. Yeah. So, timelines for verification of proxies. There are two different timelines. One is any member who want to verify the proxy forms can verify. So it is all open, but only thing is he cannot randomly come and sit before the company secretary and say, show me that. So if you want to verify, you should have given the notice. Now, for giving notice, he requires minimum 3 days notice. So minimum 3 days notice is required, but when the physical verification can happen, 24 hours before the meeting till the conclusion of the meeting. So indirectly, one question can come. A member had given notice, can he come and during the meeting, can he insist that I want to see the proxy forms when the meeting is going on? That's how we can slightly put a tougher question. Listen to it. I'll put easy questions first. Can any member verify the proxy forms of any other member? Yes. But what he should have done? He should have sent the notice. Now, what is the time for physical verification when he can come and check the proxy forms? 24 hours before till the conclusion of meeting. So my question now is combining all this. When the meeting is going on, a member stood up and disturbing the meeting. He says, now I want to verify the proxy forms. He has already given the notice of 3 days, but he want to verify during the meeting. Can he verify during the meeting? So that's why open book system. So now he can verify. That is the power of this member, because at any time he can verify. Till when he can verify? Till the conclusion of the meeting. So if it is conclusion, you will write. If it is before, you will write. But during the meeting, since he didn't refer, you will get confused. So that is during the meeting also he can continue to verify. He can stop the meeting and say, no, I want to verify. Before it's taken up for voting, it is the right of every person to do it. Then, can a proxy be revoked? Revocation means what? Cancellation. Now, can I cancel the proxy after appointing? Yes, unless it is made irrevocable for valuable consideration. I can revoke the proxy. Then, I've appointed a proxy for the original meeting, but the meeting got postponed, adjourned. Now, do I need to appoint one more proxy for adjourned meeting? I repeat. I've appointed a proxy for the original meeting, but for some reasons that meeting didn't happen. Now, for adjourned meeting, can I? Do I have to appoint one more time this proxy for adjourned meetings? No. So there is a sensible point here. The proxy appointed for original meeting can also attend the adjourned meeting. But can I appoint a fresh proxy just for the adjourned meeting? The answer is yes. So, provided I satisfy this 48 hours deadline and all that, a fresh proxy can also be appointed for adjourned meetings, but not necessary. The proxy appointed for original meeting is as valid as for adjourned meetings as well. Then, what happens if I am appointing 2 proxies? So, that is, can I appoint multiple proxies? It is my wish. I can keep on submitting proxy forms. So then which one will become valid? The latest in time. That is the second in time will become valid in that. So you got questions based on this. It's a simple one. So I'm not really getting onto this. Then this question, appointing 2 proxies, will also, there is another angle. Can I appoint 2 proxies by splitting my votes? Because in this case, for all 100%, first I have appointed as a proxy. I change my mind, now I appoint him as a proxy. Then who is valid? Whosoever I have submitted latest, he will become valid. That is what he is saying. That is a simple point. But the another point that we need to see is, can I appoint multiple proxies by dividing the votes? So, yes, you can do that unless your articles prohibits it. So, if your article says, you can't do it, you can't do it. Otherwise, if I am having 10% votes, I can appoint 2 proxies, one with 5% votes and one with a 5% votes. So, I can send 2 different proxies. Both of them are valid. I am dividing the votes, not that second in time and all. I can send multiple proxies to a meeting on my behalf. That is permitted. Then, can a representative of a company, the standard routine simple question, company had asked one director to represent them, but the director want to appoint a proxy. So the question comes from, now the basic one, who can appoint a proxy? Now you tell me the basic question, who can appoint a proxy? Only a member who is entitled to attend can appoint a proxy. But can the representative of a company also can appoint? But in our case, company is a member. Representative of a company is not a member. So can he appoint a proxy? The answer is yes. So because the 2 representatives will have the same powers like members. Who are that representatives? Representative of company and representative of president or governor. So they have all the powers on par with the member. So they can speak, they can vote, they can do anything about it. So that is what are all these points on this proxies. Then voting. What are the various, this is a simple one. What are the various types of voting? Show of hands, electronic means, demand for poll, postal ballot. I will touch on important ones. Now, in the show of hands, when the decision will be treated as final? Show of hands, that is, you raised hands. But maybe that is what I'm trying to say is when it gets legal finalization. Now, when the show of hands, the meeting will be treated as conclusive when it is declared by the chairman and when entry is made into the minutes book. That is, there may not be any recorded version of it, how many hands, and in the ballot voting what happens, you have a proof, you can go for recounting. But show of hands, there is no question of recounting because people have raised the hands, they have left the meeting. Now, but you can't ask for repoll. So in that case, is that show of hands, when will it be treated as a final? No opening, no question of reopen. If it is declared by the chairman and it is recorded in the minutes, then it's all dusted and closed. So it cannot be challenged and it cannot be reopened. So that's all this points on this. Then this e-voting, the important points I will touch it. Otherwise, can the company do this electronic voting? The answer is yes. The company can do remote e-voting or through electronic gadgets. Now these points are important. Now, e-voting, when the e-voting should take place. Now, just as a summary, since, though however it is revision topic is simple, I'll just take one step back and I will explain what is this e-voting and then we will discuss on the important concepts. What they are asking is, when I say I want to conduct a meeting, but if it is a physical meeting, then members have to travel all over the place. But it may not be convenient. And that too in a current days when we have all this multiple video facilities and all this, really there is no need to spend and take so much of hardship. So people can join, send a link, Google link or Google Meet or whatever it is, people can join. So in that case, and even for voting, why they have to come all the way, come to it just to cast the vote and all that. So, and company won't reimburse. That is where a decision has come. Can you send a link whereby I can sit and vote? That is what we call it as a e-voting. So e-voting is a remote e-voting. So shareholders are, there is no meeting. Shareholders are opting their vote, sitting at their own place. So is that permitted? The answer is yes, it is permitted. Now, you tell me conceptually, wherever e-voting is happening, will the e-voting happens first or the physical voting happens first? E-voting happens first. So when that e-voting, it must always remain open for not less than 3 days. And when it should close at 5 o'clock the day before the general meeting. So that is first e-voting slots will get over and then the physical meeting will happen. Your questions, probable questions on this topic are only around this. Now a question comes. A person who has voted in the e-voting, can he attend the physical meeting? Yes. But what he should not do? He should not cast the vote again. So, but he can come and attend it. So, what that is, in the e-voting concept, you cannot change your voting subsequently, nor you can vote it again one more time in the physical. You can attend, but you will not be allowed to do that. That's all. And then all these points are the simple points. Demand for poll and all this are the simple ones. More than 10% and postal ballot, in the interest of time, I'm just skipping it. Now coming to this resolutions, there are two resolutions, ordinary resolution and special resolution. Majority, you know it. When I say ordinary resolution, how much majority? Simple majority, 50%. When I say special resolution, how much majority? 75% of the majority. So on and off, in a very rare scenario, he is asking what are the characteristics of a special resolution. So it's a simple and light one. You must have minimum 75% of majority, and the notice must clearly say that it requires a special resolution, and of course proper notice of 21 days, clear days and all are required, and if it is a special business, then it must also have the explanatory statement. So once those are there, then it can be taken up for this one. Then comes the minutes. This is also a very small concept and very easy concept. Now, minutes is nothing but written record of business transacted and all. Now, very simple one. What the minutes must contain? The minutes must contain fair and correct summary of this. What are the exceptions? Who can exempt? That is, I'll go little slow here because this topic is important. Only one small topic, but so it's a routine regular one, but still I'll hold on. What do I mean by minutes? Minutes are nothing but a written record of whatever had happened in the meeting. If I write it in a piece of paper, it becomes my minute. So it is a written record of it. Now, then what I should write here? It must contain, as per this provision 118, what it says that what my minutes must contain, it must contain the fair and correct summary of proceedings, what had happened. That is, whatever had happened in the meeting, same thing should have been recorded here. But what if in the physical meeting, there was a fight among the people, each one was scolding the other one and all that, then do I have to go and write as it is, like what had happened and all that? Not required. So, but though it is supposed to be a fair and correct summary, if the chairman believes that certain words are derogatory, or that is what we will see, just as an example, then the chairman can ask this company secretary to omit being recorded. Indirectly, though there is the law says whatever had happened in the physical meeting you have to record, but not all the cases. There are exceptions. The exceptions are in these three cases. When a chairman can exclude recording of it, when the chairman feels it is defamatory, or when he feels it is irrelevant or immaterial, or when he feels it is detrimental to the interests of the company. In any of these cases, the chairman can order for omission of that item in the minutes of it. These are the ones. Then the only probable question he is asking is, who will have to sign the minutes? Now you tell me. Because since it is a revision and a small concept, who will have to sign the minutes book? Chairman of the meeting. But if the chairman is not available? If the chairman is not available, so this is what is the point on who will have to sign the signature of this minutes book and all this. If it is for board meeting, the provisions are different. If it is for general meeting, the provisions are different. If it is for general meeting, then the chairman of the meeting will sign. But for any reason he is not available, any director authorized by the board of directors will sign. But if it is a board meeting, the chairman will sign of that meeting. But if the chairman is not available, the next succeeding, that is the chairman of the next succeeding meeting, he is going to sign. But in the case of general meeting, they won't wait for the chairman of next meeting because that may happen after a couple of months. That's why the board of directors are going to authorize a director authorized by the board of directors can sign this minutes book and all this. Then this verification of minutes and all that is all right. The only probable question he can ask you is, can a member request for a copy of the minutes? Because the minutes will contain the confidential data. Can the member request for a copy of it? The answer is yes. He may have to pay some money, but as long as he is paying the money, the company has to give this copy within 7 working days to the member and all this. Then these are all the small points, register of members and index of members, all this. Now, just broadly I will touch this foreign register and all this. Now, conceptually I will discuss, because instead of discussing the logic, continuous point by point and all, since it's a revision, what is a foreign register is a register containing my foreign shareholders. That is what is called a foreign register. Now, that is, he is asking, it's all about the register of members. Now, I will ask the base question. Where the company should maintain the register of members? Which place I should maintain my register of members? Registered office. But if my shareholders happen to be in a foreign country, then can I maintain it in that foreign country? is that question. That is the foreign register. So this foreign register is a register containing the list of foreign shareholders. So can I maintain it in a foreign country? The answer is yes. But there is a limitation. I can maintain in a foreign country, but there is one condition required. That is, at frequent intervals, that data has to be sent back to the Indian entity. So, that is within 15 days from the time you make an entry, it must be transmitted back to the Indian entity. So, with that condition, that's the only condition he is asking, and that's all fine. Then, the other question he is asking is, look at this one. Where should I keep my register of members? Now this he is asking, so I'll go, I want you to, because since it's a small topic, we were moving little fast because we have to cover a lot. Now this one I'll hold, because he is asking questions, repeat questions. Where should I keep my register of members? Ideally at the registered office, but can I keep it at any other place? The answer is yes, I can keep it, but two conditions. There must be a special resolution, and 1/10 of the members must be residing in that place. Now this one, there is a slight difference between keeping. Since it's a revision, you all studied this accounts of companies. Generally, looking at a macro view, where the confusion comes is, there are 2 points. Where my books of accounts are supposed to be kept, and where my register of members is supposed to be kept. Both the ones, ideally I should maintain it at the registered office, but if I want to keep it at any other place, then my approval mechanism is different. So if it is register of members, then 1/10 of the members must be residing and there must be a special resolution. But when it comes to the books of accounts, not required. Board resolution is sufficient enough, and whether my members are residing there or not residing there, I can still shift my books of accounts. So whenever it is books of accounts, 1/10 of members residing, that is not necessary. I can simply do that. Now, that is this point on this. And then finally, preservation and all that you can handle. That is a small stuff and all that. Closure of register of members. So, the small one. Closure of register of members. That is, can I close register of members? When I'm closing register of members, that is no transfers are accepted. Very negligible probability of questions, but there are 3 timelines here. So I can close my register of members. There are 3 timelines: 45 days, 30 days, and 7 days. Now you tell me, what is 45 days? This concept, I will go little. Power to close register of members. That is, can a company close a register of members? Indirectly, the company will not accept any transfers because they have frozen their members. Now, in that concept, there are 3 dates: 45 days, 30 days, and 7 days. What is 45 days? Aggregate closure of days. That is, in a year, I cannot close my register of members for more than 45 days. Then 30 days is what? At a time. So at a time, I should not close more than 30 days. But then 7 days is, whenever I want to close, I have to give a notice of 7 days in advance. So to sum it up, with regard to closure of register of members, there are 3 timelines. Now you tell me, what are the 3 different timelines? 45 days, 30 days, and 7 days. What is 45 days? Aggregate. And what is 30 days? At a time. And what is 7 days? Notice that is required before closure. That's all. Very rare. Not a repeat question. Not to worry. Very rare question that he is asking. Then annual return. Now this is only one point is important. Disclosure. There are 2 things. What are the contents of annual return and what is the time limit for annual return? Contents of annual return, don't even read. You can read everything. Meetings conducted, directors appointed. That's a free type for you. Now, you tell me, when I have to file annual return? Within 60 days. My 60 days starts from AGM. But what if AGM had not happened? So, if AGM had not happened, this is what is the one chart that you need to remember for this. That is, Do I have to file annual return? The answer is yes, I have to file annual return. Now, what are the time limits? If AGM is held within 60 days of AGM, and if AGM is not held within 60 days of the due date, that is when it is ought to have been held, but I must file AGM, whether I must file annual return, whether AGM had happened or AGM had not happened. So 60 days will remain the same for it. That's all. So that is what is this point on it. Then I will go to this last topic of this chapter, that is beneficial owner. Now, this is the important one, and I just want you to focus here. Get hold on the documents of it. And the probability for a question to come now out of these chapters is very high on this latest topics, because this is the one which is gaining momentum. So, get back to it. Though we had to complete it a little fast over there, but this one we will hold back. Now, owners are of two types, registered owner and beneficial owner. Now, in this, now for my understanding, you tell me, in a minor parent case, who is a minor here? Just for a clarity, is a minor a registered or is a minor a beneficial owner? So, if as a parent, if I am buying the shares in my son's name, then what am I and what is my son? That is the minor is the registered owner and the parent is a beneficial owner. So that is in many cases binami accounts. So that is in current scenarios, many people are investing in the company in somebody's name, particularly the politicians and all. They put it in a simple way, what you can connect, binami investors. So that is when this concept is gaining momentum. So registered owner is the owner whose name is registered, but he is not the one who has given the money. Who is giving the money and who is enjoying the benefits indirectly is a beneficial owner. That is this concept of registered owner and beneficial owner. Now, in this, there are three forms, MGT4, MGT5 and MGT6. Just let me see how much you remember. What is MGT4 and MGT5? Who will file MGT4? Registered owner to the company. And MGT5? I will present this. Say, what are these forms? Because probably there are only two charts. One is what are these forms, and then what is the significant beneficial owner. Small concept, but don't go by the past questions. Now we have got more probability here. There are three forms, MGT4, MGT5, MGT6. MGT4, registered owner will communicate to the company saying that though the shares are in my name, I am not the real owner and I am not the beneficial owner and the money is invested by so and so. That is MGT4. Parallelly, there is a Companies Act requirement where the beneficial owners, that is if you had invested and bought the shares in somebody's name, then you have to write a letter to the company and communicate to them. That is MGT5. So MGT5, the beneficial owner is communicating to the company. And based on these two, the company will do a mix and match. Like if I say that you are, I am the registered owner, you are the beneficial, I would have given MGT4, you would have given MGT5. Company will sit and keep a tick to it. Yes, these are matching. So company will do all that and finally they will file MGT6 with the ROC saying in my list of shareholders, though the shares are in their names, but they are not the real people who had invested and the beneficial owners are somebody else. But what is the basis of this? MGT4 and MGT5. Now you tell me, as a summary, there are three forms that we are discussing under beneficial owner. MGT4, MGT5, MGT6. Quickly, MGT4, who will submit to whom? Registered owner to the company. And MGT5, beneficial owner to the company. And MGT6, company to the ROC. So that is what is the submission of these three forms. Then significant beneficial owner. This is the most important topic and which he is asking. So earlier there were beneficial owners. Now out of beneficial owners, company, because in India it's very common for parents to buy the shares in the name of children and for the husband to buy the shares in the name of the wife and for son to buy the name. So it's all very common. So all cannot be, you can treat them as a binami and all. That is where the Companies Act has distinguished this beneficial owners from significant beneficial owners. So now the focus is more on the significant beneficial owners. But then to put that, because since the definition is a confusing one, who would become a significant beneficial owner? So this one is where I feel you got more chances of question to come, because a lot of amendments are happening, and the government, that too, they wanted to eradicate all these binami names and all this kind of stuff. There is a heavy focus being built on this, and beneficial owner you can handle MGT4, MGT5, MGT6, but the tougher ones you may be dealing with is this SBO, and in this there are special forms, Ben 4, Ben 3 and all that. So this concept, kindly hold on to it and listen to it, it will be helpful. Now SBO, who is an SBO? First of all, he is a beneficial owner, but the ownership that he is having, the benefit he is having is significant. Then how do you say it is significant? 2 points. That is, the investment is not less than 10% of shares or the voting rights or the distributable dividends, or apart from that, significant influences. So either more than 10% of each of this, or significant influence in 2 things. One is the financial policy decisions or the operational decisions. When somebody is able to, that is without investment, if somebody can interfere in your financial or operational decisions, he will be treated as a significant influence. It is like how we define our subsidiaries and associates controlling the board of directors and all that. Likewise, to put it simply, if somebody had invested more than 10% of capital in you, then but he didn't buy the shares in his name, then he will become significant beneficial owner. So more than 10% of what? It's a simple. Otherwise, if you look at the definition, it is slightly confusing. So you don't know how to remember and do that. Just a minute, it moved away. So, significant beneficial owner, more than 10% of 3 things, more than 10% of shares, or more than 10% of voting rights, or more than 10% of distributable dividends. Whoever, putting it in a more simple terms, I have invested in a company where I am getting more than 10% of the dividend, or more than 10% of the voting rights, or more than 10% of shares I am having, but I have not, bought the shares in my name. Then I will become significant beneficial owner. So that is what it is. Or without investment, like you have, I'm relating so that you can relate, like holding companies and subsidiaries, you say that controlling on the board of directors. Likewise, though it is less than 10%, but if somebody is having significant influence in your financial or operating decisions, then he will be treated as a significant beneficial owner. Then what happens when there is once somebody has become a significant beneficial owner? This process and this chart, you need to have a control on this, and this will help you understanding and digesting the lot of lengthy theory that he has given. Now, step number 1. Once there is a significant beneficial owner, it is his duty to write a letter to the company within 30 days of he acquiring that significant beneficial ownership to the company. And there is a form called Ben 1. So Ben 1 is filed by the significant beneficial owner to the company. Then based on this Ben 1, the company will file it with the ROC saying, in my company, there is a shareholder holding more than 10%, but he is not the genuine one. He is not the original one. He had not invested. Then who had invested? Somebody else had invested. Then how do you come to know? Because he himself had informed me through this Ben 1. So Ben 1 is by the SBO to the company, and based on that Ben 1, company will file to the ROC this Ben 2. So, but till here it is fine. But then, what is this Ben 4? So Ben 4 is what he can probably get into it, because this is what has been included as a amended content in your revised ICAI material. What it says is, whenever, like come here, it will come to it. Whenever I am filing Ben 1 SBO to the company, or but still the company is not convinced, they want more data, or somehow the company believes that no Ben 1 is filed, but the company got some information that one of your major shareholder who is holding more than 10%, that is 15%, he is not the real owner. So the company got the doubt. And they feel that, like how we all know that some guy is a benami of some politician, you all have some idea about it. So likewise, if the company suspect that among some their owners, somebody is a beneficial owner, then the company will directly write a letter to it. Like say, for example, there is a real estate guy who had bought the shares in my company. But I believe as a company, I know that this guy don't have the worth of investing 30 crore. So this money should have been invested by some, say, political leader. So XYZ, maybe of Congress or BRS or TDP or somebody, YSRP or somebody. Then as a company, to have a clarity on it, because as a company I have an obligation to inform ROC who is a real owner and who is the beneficial owner. But this guy, he didn't tell me. He's saying that he is a owner, but I doubt, looking at his other parameters and the information, he is not the real owner. Like in the film production and all that, you know that though somebody is a producer, but you know he don't have that much money. Somebody else he is only a benami of somebody else. Likewise, if the company suspects and it wants more information from any person, then the company will send a notice, write a letter in the form of a notice to that person asking for clarification. Maybe they want some information to be given. That notice is what we call Ben 4. So this Ben 4 is nothing but company wants some information from a third party who is not a member, but company believes that guy had bought my shares in somebody's name. So that is what it is. Then just imagine, I came to know that my competitor is buying the shares in my company to destroy it. But if he is buying in his own name, I'll come to know it. So that is why he is buying in the name of somebody else. I got to know about it because he's slowly trying to take control of it. So imagine a extreme scenario like this. You will be able to connect to this concept. Then as a company, I came to know that though somebody is investing, but my competitor is the guy who is funding the money. Then I will send a notice to the competitor saying, as per my facts, I came to know that you are the one who is buying shares in this. Give me this information. Maybe whatever I want. So I will ask him. Now, obviously, that guy don't want to respond to my notice. So if I don't receive any information or I have received any vague information, then what do? I will, as a company, I will wait for 30 days. Then he is not giving. But I strongly believe it is my competitor who is trying to buy. When I am asking for a clarification, he is not responding within 30 days. Then what do? Then as a company, I can't go and manhandle them. That is why what I will do, I will write a letter, I will file an application to the NCLT, saying NCLT is a court, saying that I have all the evidence to say that this guy is buying the shares in by wearing a mask. He is buying the shares in somebody's name. So I want to know why is he doing it. So, and is it true? But when I asked him, he is not responding. So I have no choice but to go to the court. So that is what is this NCLT. Now, and once I go to the NCLT, then NCLT, it is the court. It can pass any order. So step number 6, it will pass the order. So before inquiry, what it will do? Now that I am suspecting that my competitor has bought the shares, now this guy wanted to destroy my company by voting for wrong decisions and all. But when I am asking, they are not giving clarity. When I make an application to NCLT, benefit of doubt is given to me. That's why NCLT, what they will do, we will do that inquiry, but till the time we do that inquiry, so they will restrict the rights of such shareholders. Because the intention of my competitor is to participate in the meeting and vote for all wrong decisions, which I am worried about. So that is why I have gone to the NCLT. Now NCLT is cutting his voting rights. So he will not have the voting right. Till the time it is confirmed whether he is the beneficial owner or it is only an assumption of the company. So before this inquiry, they will restrict the rights. And then NCLT will do their own inquiries. And after the inquiries, whatever it is a court, so we can't say which order they will pass final order. They may agree with the company or they may agree with that. That's saying this guy is imagining I have no connections and all. If that is the court, however they conclude it. That's all. And suppose what if NCLT passes a wrong order? So then that aggrieved person will again go back to NCLT only. Normally what do? If High Court you lost the case, you go to the Supreme Court. Likewise, but here the step number 6 and 7, if you feel that you lost the case in this NCLT. Then can I go to the Supreme Court? No. Again, you have to go to NCLT only. So ask for relaxation. So ask for revisiting of it. Something, whatever it is, you aggrieved person also will have to go to NCLT only within 1 year. Particularly this piece, what you are seeing now on the screen, is what you may be missing it, or what you will not be having clarity when you read on your own. Otherwise, this proxies, membership, voting rights, adjournment of meeting, they all you will get a proper hold of it. But this last piece of it, beneficial owner and significant beneficial owner, is the one which will be very important. So this beneficial owner I will touch one more time because of the importance given to it. Now, when a beneficial owner will become significant beneficial owner, simple definition: when the beneficial owner is holding more than 10% of three things, either the shares or the voting rights or the distributable dividend. Apart from this, though with zero investment, if he can influence my financial or operating decisions, he will still be treated as a significant beneficial owner. So now what happens? What are the various forms that we will have to see here? Now, there are 4 forms here: Ben 1, Ben 2, Ben 3, Ben 4. Ben 3 we will come to it. Now, what is Ben 1? Ben 1 is something which the SBO will have to give it to the company. So, saying that, yes, I am the person, genuine persons who are investing, they will come back and say that, yes, I am investing and this is for so and so reason. Then it is SBO to the company, Ben 1. Based on Ben 1, company will file it with the ROC Ben 2. But if at all the company gets any doubt that somebody is the benami of my shareholder, then they will send this notice in the form of Ben 4, and the company will wait for 30 days. If 30 days you don't receive any response, then you will go to the NCLT. Then NCLT, what they will do, till the time they complete the inquiries, first they will stop, like stay order type. So they will stop the rights of the shareholder, and then they will do the inquiry and pass appropriate order. But because it's a court order, there is one winner, one loser. Then the company can be the loser, or SBO can be the loser. Then what they can do? Can they go to the appeal to the next level of court? No. They again will have to appeal to the NCLT only. So these are the points. Then what is Ben 3? Whatever the forms that you have received in Ben 1 and filed with ROC, the company will have to maintain a register of SBOs, and that is what is in the form of Ben 3. So this is Ben 1, Ben 2, Ben 3, Ben 4. We'll just revise this Ben 1, Ben 2, Ben 3, Ben 4 and wind up these classes. So Ben 1 by SBO to the company, and Ben 2 company to the ROC. Ben 3 is a register to be maintained based on Ben 1 and the information given in Ben 2. Then what is Ben 4? That is an odd man out. So Ben 4 is a notice. Who is giving this notice to whom? The company is giving to the suspected SBO. So asking for information. But if he is not giving, then what the company can do? Company will go to NCLT. So, and what the NCLT will do? Immediately they will pass a stay order curtailing the rights of it, and then do the inquiries and pass it. What an aggrieved person can do? Again, he will have to appeal for relaxation to the NCLT only. So they cannot go beyond NCLT. These are all this: Ben 1, Ben 2, Ben 3, Ben 4. So in this, from MCQ's perspective, MGT 4, MGT 5, MGT 6, and Ben 1, Ben 2, Ben 3, Ben 4. So, and recently also, Companies Act is making a lot of modifications to these forms in reality. So, this is a happening topic. So, therefore, it is important to be on the grips of it. So, with this, we are done with this chapter. And when we meet tomorrow, how I wish to proceed, I will just give a overview of it. Now, this other loss also very significant, and that will easily help you score this 30%. So we start with this Companies Act. I'll keep it on a hold because the remaining topics, accounts of companies and auditors, we need to discuss. But prioritizing the time available and the completion. First, because since you would have just come at 8:30 and all that, I won't start with FEMA because it's a time and you have to settle and all that. So we start with General Classes Act, and we'll finish that General Classes Act and interpretation. And after that, we will get into FEMA. So that FEMA and LLP Act, if we discuss, that itself will contribute significant amount of contribution to your percentage. So tomorrow the basic focus would be on this other loss and then based on the time available, I will prioritize the accounts of companies, then audit and auditors, and companies incorporated outside India, then the prospectus. So all these remaining topics. But the first priority should be to this other laws, that too in this order: General Losses Act, Interpretation, and then FEMA, and then LLP Act and all this. So this is what we will discuss when we meet tomorrow. So for today, let's stop the class. Thank you all.